There we go. Welcome to the next stop on your journey from paycheck to pension. If you're ready to take your finances to the next level, you're in the right place. It's time to take control of your future, starting now, and we're doing it live. Hi, we're the Stidhams, and our goal is to help you get self-directed. It's the tax-free income that will shape your legacy. It's wealth, time, and the freedom you deserve. What you're about to learn will enable you to make confident and strategic moves. It means gaining complete control to invest in what you want when you want. We've helped thousands of people just like you. And if they can do it, you can too. So we hope you're ready, because it's about time that your money started working for you. And we're so excited that you chose us to show you how.
Starting right now.
There we are.
Money hit me in the face.
Welcome, everyone, and welcome back to our conversation about reverse velocity banking. Gosh, why am I up so high? Fix that. Tonight is just going to be a Q&A to get all of your questions answered. Wednesday, we had to end the stream a little bit early, and that was not a vibe. However, now this is just for you guys. Let's get the questions in and let's start answering them. Donnell, we have some from the comments because we did ask you guys to put them in the comments of the last video. And so we can start to address those here, making sure that we answer all of them. Of course, there's been a lot like, Donnell, isn't this just like infinite banking?
Are you wanting me to answer now or wait till some more people get in here? You tell me.
Yeah, no, let's go ahead.
Jump right in?
Yeah.
Okay, here's the thing. Is this just like infinite banking? Well, it could be. It actually should be. But that would only be if the, I'll call it the carrier that is, I'll call it producing or providing your mutual life insurance policy would allow you to take the participating loan and put it back into your policy as brand new premium. Because the truth is, this concept is not special. It is a leveraged IUL. So think about it. If you could apply leverage inside of your whole life policy, if you could apply leverage inside of your IUL, this is kind of a mute conversation because everyone would be able to do it. But not every life insurance company would allow that strategy. So I think a better question to ask is why? Like, why isn't this allowed? What's the harm to the life insurance company if this were to be allowed? And I think what's going to happen is as life insurance companies pick up on this strategy and realize, you know what, there's a win-win here for everybody. I think this will be less of an exciting topic because in truth, we're just talking about a leveraged IUL. And that's kind of what we're going to talk about today.
Yeah, but how to leverage your assets. And I think that's the key piece is that this is... learning the strategy is more important than it's not more important than the product. I won't say that, but the strategy itself and how you're using it or how you're leveraging it is also part of the equation of why this works. And so you change the variables in this equation and the outcome will change. And I think that's the part that a lot of people are going, well, hold on a second. What if I did this? Or what if I structured it this way? And it's like, well, could I do this with a whole life policy, right? And the answer, what do you say about that? Because we've gotten some questions about that too.
Well, it all kind of says the same thing because the truth is, imagine we were just simply talking about velocity banking, and there was someone who said the only way you can do velocity banking is with a credit card or maybe a personal line of credit. Only to find out, you know what, if I structured my home differently and I got a first position home equity line of credit in place of my home, wow, the power that I have in doing velocity banking. To me, this is no different. We've been doing infinite banking a certain way and it's been applied a certain way. But you know what, if we take another vehicle and structure it differently, can I apply the same process? And the answer is yes.
Okay, we have a very interesting question that came up. It's not about reverse velocity banking, but I think it's an important one. Okay. It's from Jeff Adams, and he's new to our group. By the way, Jeff joined Facebook for the first time just to join our group, and we are so honored about that.
Yeah, I think that's pretty awesome. Like we're pulling people out of the backwoods to now join Facebook just to hang out with us. I think that's pretty awesome. So
yeah. And Jeff says, good evening. Could you give us a brief history of what you two, maybe how you guys changed your mindset when it comes to finance. What was your aha moment?
Ooh, there's a lot of them.
Yeah.
So you want me to walk through that, sweetheart? Because it's
Yeah,
kind
I
of
mean, if
long. It's
yeah,
long.
I would definitely put your questions in the chat and we'll be sure to answer them. But I do think this is important because
Yeah.
I think this is what stops a lot of people from even wrapping their mind around a strategy like this is they can't get through the weeds
Yeah.
of all of the programming or conditioning that they are battling already that's already in there, right? So the forest through the trees, they're just hitting uh every tree on the way through the forest and they're going, ouch, this hurts, this feels uncomfortable, right?
Right.
And we've had a lot of that experience too. I mean,
Yeah.
we're still on our healing journey
Absolutely.
in terms of that. So you want to go first?
Sure. So I think it starts with 2008, right? What happened was we were caught up in the market crash or the housing market crash or whatever the case may be, and ended up having to short sell our home. And in the process of short selling our home, we were placed in a position where we now had to rent again. And my credit score went from seven, whatever it used to be, down to like 500, or I think it was like 504 was the lowest that it had gotten. And once we had gotten through 2008, and it was time to now put ourselves back in a position to where we can actually buy a home again. The truth of the matter was we couldn't qualify due to our credit profile. I had just started a new job. Like there was all sorts of reasons why. And we had assumed that we were going to take a different direction. And a part of that direction was, hey, we were going to jump into the real estate, learn some new things in the real estate arena. And instead of focusing so much on traditional retirement planning, real estate was going to be our retirement plan. And I think in the midst of all of that learning, I stumbled across some different concepts. One was how to leverage a previous employer's retirement account to be able to grow wealth. And then also stumbled across velocity banking and realizing all of the efforts that we were doing to get ourselves back into a much credit worthy position really wasn't working. But the minute we introduced velocity banking, and when I say the minute, I mean within the following month, my credit score probably jumped 30 points just in instituting velocity banking and restructuring how we were using a dollar, getting multiple uses out of the same dollar. And so I think the aha moment for me was all of those videos that I was binge watching associated with Denzel Rodriguez around how to use a dollar multiple times. And in the process of doing that, other, I'll call it avenues or paths started to open up and we started moving down those. So I think the original moment, the initial moment was when I learned about velocity banking and the power of velocity banking. What about yourself, sweetheart?
Yeah, and there was another guy that you shared
No one
with
knows who
me.
Zach Allman is. So,
Oh,
so
yeah,
that
because
was the, yeah.
you watched a lot of his videos too.
Well, what it
Um,
is, I was in a Renatus community. You guys may know what Renatus is. I was in a Renatus community, and Zach Ullman was presenting velocity banking within that community. And so it was the live action participation with the whiteboard and how to change the trajectory of someone's economic stature through the use of velocity banking. So it started with Zach. To be honest, started with Zach, but then I had to Google it and find where else could I learn about this, and then it transition over to Denzel. So you're right.
yeah, for me, I think it was when I had graduated from college and I got sick. I got really sick with a chronic illness, and they couldn't figure out what was going on with me. And I had all these hopes and dreams of the career that I was going to have as a result of all this money that I had just spent on this degree, on these degrees. I have three, right? And I was just mourning like my future. And they were telling me things like I would be in a wheelchair the rest of my life and I'm just going to be bedridden. Like, and I just kept getting sicker. The more medicine that they would give me to fix me, I was getting sicker and sicker. And just learning how to advocate for myself, and I think giving myself permission to advocate for myself took away the, I would say, vulnerability that I felt when going to somebody who had answers or supposedly had answers that I needed and solutions that I needed access to, right? In order to change what my future was going to look like. I think giving myself that permission to research and self-direct my education on whatever that topic was kind of that gateway into, first it was my health, then as soon as I could get feeling better, then it was wealth, right? Because your health is your wealth. For me, I think it was really starting to understand how I thought about wealth, how I thought about money. And for a long time, this kind of this is how I grew up. This is the people around me. Like, this is the standard that I'm willing to accept, or I'm not, right? I'm either accepting it or I'm not. I'm going to do something different about it. And watching you go through the velocity banking and seeing, like, in a short period of time how things were changing, and I was like, wow. Well, essentially that's what I was doing with my health, right? Like, we had these parallel journeys going on, and I wasn't in a wheelchair and I wasn't in bed anymore, and I was starting to slowly improve, and these were things that I was doing on my own. These were not things that my team, huge team at Mayo Clinic, were helping me with, and I fired all those doctors, right? And I started doing things on my own and taking control. That was really what I did, was I took control. And I think that's just been the theme since then. So you fast forward and it's personal development and classes or courses or workshops that we've gone through, or books that we've read, or just the time spent in really diving into what is it that's holding us back. Not just the, we need more to make more money, we want to make more money, because that's really not the point.
Right.
It's being able to utilize what you currently have and thinking about your approach in a different way. A lot of people say, like, no pain, no gain, right? Well, I can tell you I was in a lot of pain, wasn't gaining, right? They can say, work harder, like hard work pays off. Well, sometimes it doesn't. Sometimes people are just wasting their time and they're being undervalued, right? So I think that the work smarter, not harder, is where we had to go. And primarily because I wasn't able to jump into my career to work harder, right? To do all that hard work that was going to pay off. I couldn't do that. The other thing was I did have jumped into another industry that I was able to do from home as I was feeling better. And even that, I realized had a cap on it. So that it was constantly moving towards the, okay, how can I structure this so that it's unlimited potential? How can I think about this so that I'm not just trading my time for money all the time? Because I realized quickly that you can't rely on that. You can't depend on that. Mine came early for me when I could not trade my time for money in that same way. For some people, it may not happen until they're late in their golden years, right? But for me, it came early, and that was enough of a realization to say, why can't we just retire early? Why can't we focus on retiring as fast as possible so that we can retire early? Not just that, but when I started to lose my vision, that was really scary. And I think that's at the moment when we started to pay attention to what you're losing when you're just focused on, okay, fine, we're going to do this until we're 60, right? Okay, fine, we're going to keep working until we figured it out and do these traditional things. We started to quickly realize that, what if next year, like
It's not possible. Right.
yeah, what if next year I can't see anything and I'm missing out on all these experiences? And really, it was this moment of putting life in your years and not just years in your life, right? And finding the balance of being able to utilize your time and getting your time back, creating systems and having systems work for you so that you can have your time back. And that's really what at the core of everything that we talk about and everything that we do. Our mission is to help more people have that, not because something they had to experience some adversity, they had to experience something, some sort of loss to be able to figure out why that's important. Because if we can figure out right now, that's not just important now, it's been important. We've been missing things, and we only have this one life. And so it's better to leave it better than we found it. And that's what we do when we create generational wealth. So now we have peeled back those layers, and we realize what our kids will be facing if we have these challenges in our adulthood. what are they going to be facing, and how can we help them even if something were to happen to us tomorrow, right?
You said so much there because there's this level of accountability that we had to take because no one was coming to save us. No one was
Right.
Mayo and their team of whoever could not save you, and help your situation improve. Like that's what we learned. And when you learn that, you know what, these financial institutions that you've been putting all of your trust in, they're not going to save you. You have to take control. You have to take ownership, which means you have to be a bit accountable and go, you know what can I do different here? What role can I play here? And hopefully, what you're learning from this channel is there's a certain amount of things that we just didn't know we didn't know. And as you start to learn these things, you can then take accountability for, you know what, I can actually play a larger role in this process, take more control over my destination, and actually change the trajectory of where it is I'm headed just by simply owning this position that I'm in. I don't blame Fidelity for the fact that the market crashed and there was nothing that I could do about it. I don't blame the company that I work for not being able to control that company 401k that I couldn't access. But you know what? The minute I left that company, I could take control of that 401k. That's exactly what I did. And in addition, this life insurance policy that was provided to me that maybe wasn't structured properly, when I learned that, you know what, if you just tweak things a little bit differently, and again, I can't blame the person that sold it. I, I was wrong for trusting the person that sold me that policy. It's on me to kind of learn what these opportunities are and where these specific control knobs can be to be able to make this thing a little bit different. And then once I do that, you know what? Guess what? Things look a little bit different. So you're absolutely spot on. Self-directed is about you taking control, you owning where you are, and you taking the necessary steps to change that position. And it's through education.
Yeah. And sometimes you gotta dig to find it, but
Right.
it's worth it. Every single time, it's completely worth it. And I see some great shares happening in here in the chat. And I really appreciate that question, Jeff, because I think if it wouldn't have been for some of these moments in our life, the hardship, right, that we faced, I don't know that we would have taken it as seriously.
Right.
I sincerely don't know if this would have been so urgent or become a priority, or if the stuff and the things would have ended up taking up space in our time within our funds, because that's where we were before, right? And that's what we thought it was okay to do. We had all the permission from, normal societal standards to play into that. Christmas, holidays, whatever it is, like all of those things, we just were playing right along. So I don't know if we would have done anything different. Don't I would imagine, I would hope so, but I actually don't know that we would have had this alarm in our lives to do this. As a result, though, sometimes I struggle because it's not like the illness went away, right? So sometimes I struggle and I have to remind myself how far I've come. And I think that's important too. But so to me, if I were to give anybody else any advice, is to use your struggle as an opportunity to be the teacher through your struggle. Use it as what can I do here that if somebody else that I loved so much, pick somebody in your life, if they were going through what I'm going through right now, what is it that I can do to help them have a map on how to get out of this situation and how to improve this situation? And essentially, that's what we did. We did that for our kids, right? And now we've done that for hundreds, if not thousands of other people. I don't know, we're not counting at this point, but it's thousands of people who we've touched over this last decade or so that we've been doing this. And so I would say for anybody who's just starting in their journey, anybody who's gotten a couple of years into it and they're feeling tired, like, I hope that learning these strategies and being here, educating yourself, this is the permission that you're giving yourself to change your future and the futures to come, generations within your family. And I'm proud of you for doing it. If no one else has told you that, I'm proud of you for doing that. So thank you for that question, Jeff. I really appreciate that.
And as powerful as all of that is, I also have to. You said it, so I have to. When you say it and it jogs a thought, I have to share it. Um, you know, I think we've done a really good job of educating the masses around what this could look like. But in truth, we would have never been here. We would have never been here had it not been for my wife pushing us to this point. And I share that because it's not just you taking control, it's also the team around you and how that team works together towards that goal. Will this make the boat go faster? That mantra that we talk about often.
Right.
And one of the things I've learned just about relationships in general through all the personal development and things like that, I'm going to try to articulate this, but I may miss a few points. I'm sure my wife will help clean it up. But it's something like this. As a male and as the man in this relationship, I know my job is to create. And what my wife does a great job of, and what most women do in general, is they multiply. So meaning, yeah, this is something that I see. I think I understand my superpower in the ability to be able to take something that seems complicated, break it down into bite-sized pieces, and educate others with it. I think that is my superpower. Well, the truth is, if I just allowed myself to do what I was always doing with this power, yes, I was still touching people. Yes, I was still having impact, but the impact did not look like this. And I think the truth is when you are in sync and you're working together towards a common goal, the analogy that comes to mind is the chessboard. I don't know anything about chess, by the way, but if I'm the king on that board, the way the game is successful, or the way you're able to achieve whatever the goal is as it relates to chess, is you have to allow the queen the room and the space to be able to move, because she can move anywhere. The king can move one space forward and one space back. That's about the best that he can do. But if you allow the queen enough space to be able to work the magic that she's able to make, what ends up happening is you end up winning. And I think that's what's happening here, is you being in a position to be able to curate, you being in a position to be able to multiply, is I think what has allowed us to be able to reach the people that we have been able to reach. And I don't think we've scratched the surface on where we could go with this, but I just want to make sure it's clear. We are not here if you didn't do your part, and that is push us to this point, just so we're clear.
Thank you. I love that you said that. But at the same time, it's also for those who have been on the receiving end and they've reached out and said, okay, now me next, right? I'm next. Right. And that part right there, there's a few people raising their hands in the comments like, I'm next, please. Tell me, here are all of my ingredients. Now you tell me what I can create with all of this, right? And we're here for that, because our situation isn't your situation. Everybody's different. And you got to know what to do. And so if you are looking for which one fits me, or you learn the strategies and now you're able to have the control and you're able to create something, regardless of what life brings your way, right? You're able to then implement strategies that make sense and help you reach your goal. So I thank you for sharing that, because it has been a journey. And Absolutely. Teamwork makes the dream work, man, but it is a journey. Okay, we have a question here from Connie Hooks. My daughter is watching and she is 27 years old. How can this work for her now for the next 20 or 30 years? Great question.
And I love the fact that we have the opportunity to share information like this with people who are in their 20s. And, one of my favorite stories is around a gentleman who was 20 years old when he reached out to me. So what can you do? Well, here's the thing. As a retirement consultant, what I am not going to do with a 27-year-old is talk about, hey, here's what you can do. And in 30 years, 35 years, when you turn 65, you can now access your money to be able to, go live your life and retire comfortably. With the 27-year-old, the first thing that I want to make sure is clear is, if you do this correctly, you can actually put yourself in a position to where you can fire your job. You can put yourself in a position to where you could actually think about or focus on retiring early. And if you think about it, what traditional retirement process that you know of will allow you to retire before the age of 59 or 65 or 72? How about none? And I think the biggest piece here around the strategies that we share is majority of them will put you in a position to where retiring early is actually an option for you. And so I would say, if you do this right, if you take a look at what it is you make on a annual basis, take a percentage of that dollar amount and put it away, similar to what we did with Abel in this example that we did over these last few weeks, and you allow that money to build for you, allow that money to work for you. You could put yourself in a position to where you could actually fire your job at some point, meaning the income being produced by a vehicle like this could actually replace your income. And once it replaces your income, that now places you in a position to where you can now focus on why you're truly here. Whether it's your purpose or whether you love your job and you want to play a certain role within the company that you work for, regardless of what the reason is, what you're doing is you're placing yourself in a position to where now you have more control over that situation versus you being dependent upon that employer that you work for to now provide you with your necessary income or needs being met. You have more control over that to be able to dictate and determine what you want that to look like. So that's what I would say.
Yep. Okay.
Just so we're clear, also, in addition to answering questions today, one of the things that I did not do, usually what happens when we walk through a strategy, a lot of the questions that I've received this week as it relates to reverse velocity banking has been around how is this even possible? And what it says is we've been talking to actually I've been talking to a lot of clients this week who are fairly new to what it is we share. And so there are several who have not watched me walk through how money grows inside of a policy like this on an annual basis and how money actually grows in a product like this. So I also did prepare some slides to actually walk through how money grows from year 1 to, let's call it, year 3 or year 5 or whatever the case may be, to kind of help people understand what this is. When I say an IUL with leverage, what does that even mean? Because a lot of the new people that are now spending some time with us based off this subject, they heard velocity banking. They didn't necessarily understand the strategy that we're referencing as it relates to a leveraged IUL and being able to produce income like this. So I share that to say, I'm also prepared to kind of walk through some of those details. If the questions get kind of light, I'd be happy to jump into that example as well, just so we're clear.
Yeah, I think, and I hope that, Connie, that you guys are still on. If so, we would like to know more about your daughter so that we can do a better example of showing her exactly how this could work for her. Mm-hmm. The example that we did for Abel being 25, I think is a great example, probably perfect example of starting from zero. However, if she's making more than he is, or she's got more available cash flow in the beginning to supercharge, right, her strategy, then I think that there may be a different opportunity for her than there was for Abel. What we did for Abel, though, Abel being like our recycled John, because people were saying that too, and it absolutely is, because I was just wanting to get it done. I think that this is where a lot of people are, regardless of your age. You're in a place where you're starting with what you got. Right. And that's okay. There has to be a strategy. It can't be, well, if you don't have this and you can't do, right? We're done with that. We're going to find a way. We are going to get creative. So for some of you, you have to start with velocity banking in order to free up cash flow, right? To then build wealth. For some of you, you've got to start with debt snowball. You can't even really start with velocity banking because you are in negative cash flow. That's okay. Wherever you are, as long as you are giving yourself, one, the permission to say that it's even possible for you, right? To believe that this is possible, to take those first steps. Then the commitment to follow through. I think some people get tuckered out. They feel like this is a lot of sacrifice and they lose sight of the goal. When you lose sight of the goal and you stop feeling what you felt for the goal, right? When you lose the value in the goal, then what else do you have left? Right. And I think that's where that personal piece comes in that Jeff was asking about. Like, that aha moment was how we felt about the goal. Where the heck are we going? Where are these choices and decisions going to lead us? And do we want to be there? Because by the time we get there, it's too late to go back and change your decisions and your choices, right? But today we can all start making different ones. And that's the point. That's really why we're here. Right. So, yeah, thank you to all who are tuning in. We appreciate you. Put a Q in front of your question. That helps us to identify when we have questions come up, or if you guys are just kind of chatting with each other, which we love to see you guys doing that in there. And we also recognize that we have maybe 50% still of our viewers are watching from their TV. And so if that's you, or you're not on your phone, you're not on your computer, how do you participate? How can you ask questions? This is how, right here. You just QR code or use this number and text us while we're live. We will answer those questions up here. So we'll keep an eye on that as well. Take a screenshot if you need to. Otherwise, we're going to just jump in. You've got some examples to share, right, Donnell?
Yeah. So if we wanted to jump to the Vibe board, we can do that.
All right, to the Vibe board. Let's go.
So, and what I'll do is I'll kind of recap again. So ultimately, these are the strategies that we offer. What we're talking about is a secure compound interest account, which ultimately, again, an IUL with leverage. We're talking about a secure compound interest account that allows you to bring leverage into the policy to allow you to produce income faster. And again, what we're talking about in an example was reverse velocity banking. But in order to understand how you can reverse velocity banking, you have to first understand what is velocity banking, right? And so from this perspective, let's see, let me grab my laser. There we go. So as income is coming into your checking account, and you end up putting all of that income onto some debt tool, and then you use that debt tool to then pay all of your bills, whatever they are, what ends up happening is that cash flow ends up living on the debt tool. And then when you reach out to a person like me, because again, I'm not a velocity banking coach, but I do understand how it works. So once you have done velocity banking, using Connie's daughter as an example, once you've done velocity banking to free up that cash flow and put yourself in a much more positive cash flow position, if you don't figure out where to put that money and putting it somewhere that's secure enough to actually build wealth or grow for you, if you don't figure out where to put it, what ends up happening is you end up putting yourself back in the same position that you were in originally before you started doing velocity banking. And so the thought process is that cash flow, you reach out to me and I go, now what? Now what is your plan with that cash flow? Well, if you put it somewhere that will allow it to grow effectively, you can actually put yourself in a position to where you're building wealth. Hence the thought process behind reverse velocity banking. And the thought process around that is, okay, your income is still coming into your checking account, but you know what? What if you were in a position to put all of your cash flow into a wealth generating tool, into a vehicle that could allow you to actually start generating wealth? And in the process, that cash flow that's building continues to grow, and then you leverage that cash flow. I guess I'll do it that way. Then you leverage that cash flow to build or create or leverage, again, inside some type of line as a line of credit, to then use that to pay your bills. So instead of your bills being paid from here, your bills are actually being paid from a leveraged dollar. And then what ends up happening is as that cash flow continues to grow, it puts you in a position to where you're actually generating income for the rest of your life. And this vehicle, this wealth tool, is just an IUL. At the core, it's just an IUL. And it's an IUL that is properly designed, though, and actually allows you to add leverage inside of it. And so as we talked about Abel being a 25-year-old who makes about $50,000 a year. And the thought process is he's going to put away 10% of his income into a wealth generating tool, into a wealth building vehicle to be able to build wealth, to be able to put himself in a position to where he can eventually create enough income to where all of his income can then go into this tool, which will allow the remainder to then pay or leverage dollar amount inside of this vehicle to actually pay his bills. So again, he makes $50,000 a year, is putting 10% away. That 10%, that $5,000 annually, is going into some type of wealth generating tool, which is a premium finance strategy or MPI or an IUL well with leverage, whatever you want to call it. And then as he's generating enough cash value, he gets to a point where, you know what, he has enough cash value in this vehicle that he can use, he can leverage the dollar amount in it to then pay his expenses. If he makes 50 and he's putting 5 inside of MPI, he's got 45,000 roughly that he's spending on everything else, whether that's rent, whether that's light and gas or entertainment, whatever it is. He's got 45,000 that he's looking to spend, and so the thought process is using a leveraged dollar to be able to make those expenses. And when you do that, that means now the $45,000 that's remaining, that 45,000 from your original income is left over, and you need a place to put it. You need a place for it to go. And so what I wanted to do, and if there's not any questions before I do so, what I wanted to do was just highlight this example, go into a little bit more detail as it relates to ABLE on how money grows year to year. And I think I'm picking the year of 2021 is when we're starting. So the thought process is, if this was ABLE in 2021, taking 5% of his income, $5,000 a year, putting it into some type of secure compound interest producing vehicle, what does that process look like? How is it possible that he's able to grow this type of income? So before I jump into that, sweetheart, I'll ask, are there any questions that have come up before I kind of jump into this?
Nope, I think we're good.
Okay, perfect. So again, 25 years of age, and he makes about $50,000 a year. And the objective is he's going to put this money away, this $5,000 a year, inside of a vehicle, and he's going to allow 10 years for it to grow. So that $5,000, what's happening here is that $5,000 is buying a life insurance product. That $5,000 is buying a life insurance policy that's worth about $255,000. It's basically just an IUL. And so what's happening is, if God forbid something were to happen to Abel tomorrow, there's a death benefit of $250,000 that would be paid out to his beneficiaries. And as he continues to contribute that $5,000 year after year after year, what's happening is that cash value is starting to grow. And as that cash value starts to grow, the death benefit, which is two numbers, the life insurance that he originally purchased, the $250,000, plus the cash value that's growing, is a combination of what's available to him as a death benefit if something were to happen to him. So getting into year one, what does this look like? Well, that $5,000 is going to be placed into, I call it a bucket. This bucket is just the general fund. All cash value life insurance policies have a general fund, all of them. And what happens is, when this dollar amount goes into this bucket, this general fund has a special or unique feature. And that feature is no loss due to market risk. There is a contractual guarantee in this bucket that says, when you put your $5,000 into this bucket, there's a contractual guarantee that you can't lose the money that you've placed into this bucket. Imagine your 401k. Imagine your 401k with the contractual guarantee that says any money you put into your 401k, there's a contractual guarantee that you can't lose it. How much more powerful would your 401k be? How much more powerful would your IRA be if you were able to put away $5,000 a year, and there was no concern that, regardless of who was president, regardless of whether or not Elon Musk went to space or not, you weren't in a position to where your money was at risk and you were in jeopardy of losing the money that you've contributed. That's what makes a product like this so powerful. So what I ultimately, and then the growth on the money inside this general fund on average is around 5%. It's about somewhere between 3 and 7%. And so that means the money in this bucket, once you place it in there, is going to grow a certain dollar amount. And then what's going to happen is, we're going to take that dollar amount and we're going to use that dollar amount to buy an S&P 500 call option. And I'll dig into what that sounds like or what that looks like. But the bottom line is, this is the example that we're going to walk through. And so what I want to do is just highlight year one. I'll do it there. So again, you're paying $5,000. This is year 2021. So this is an actual point in time. And you're putting away $5,000 a year. So that $5,000 is going into this bucket. And when that happens, that $5,000 is protected by the 0% floor. And that $5,000 is going to grow for you on average somewhere around 5%. Well, 5% of $5,000 is $250. Once you make that $250, someone way smarter than me is going to take the $250, not the $5,000. It's sitting there, not touched. But someone way smarter than me, an actuary, is going to take that $250 and buy a one-time call option in the S&P 500 index. And again, this is a one-time action. It's a one-time point-to-point, so it's 364 days after you contributed this $5,000. So that $250 is then going to be taken, and we're going to purchase a one-time call option in the S&P 500 index. And usually the question is, what is a call option? What does that even mean? And this is my high-level example as to what a call option looks like. So again, someone way smarter than me is going to take that $500 and say, I believe the S&P 500 index is going to close somewhere around 4,300. Well, if that index closes less than that, then because of that 0% floor, the money that I use to buy the call option, okay, I lose that, but I don't lose anything else. So regardless of how bad the market might crash, I am not impacted. Only the dollar amount that I use to buy the call option is impacted. Well, in 2021, what was that performance? It was actually positive performance. So in 2021, when I bought that call option using the $250, saying the S&P 500 index was going to close at 4,300, it actually closed at 4,700 or above 4,700, which means the market grew, or the S&P 500, that index performed at a plus 27%. Now, it would have been nice had I made that 27% on that call option, but I didn't. There's a cap on how much this call option, or how much of the performance I'm able to take on as a result of this 27% growth. And that cap is right around 10%. The average over time is right around 7%. So in truth, in 2021, I made the full 10%, but let's just use the average. So what that means is I said the S&P 500 was going to close at 4,300. It ended up closing at 4,700. So I ended up making 7% on the money that I made. And if we just doing some simple math, 7% on $5,000 plus the dollar amount that I used to buy that call option, in total, let's just say, and again, I'm making up a number. Let's just say you made in total $500. When you make that $500, it goes where? It goes back into this bucket on top of the original $5,000 that I used. So at the end of year one, in 2021, at the end of year one, my $5,000 makes somewhere around $500, which means at the end of year one, I now have $5,500. Pretty simple. So that is year one. My $5,000 made about $500. I ended year one with about $5,500. End of story. Well, here comes year two. And year two, just so we're clear, is 2022. Something happened in 2022. And we'll talk through that. So I put in another $5,000 on top of the $5,500 that's already in the bucket. So when I put my additional $5,000 on top of the $5,500 that's already in the bucket, I now have $10,500 available inside the general fund. Now, for those of you who understand cash value life insurance policies, if I needed $2,000 to be able to fix my car, or if I had an air conditioner go out and I needed to spend $5,000 to be able to do that, what you can do with a cash value life insurance policy is this cash value is available to you. So there's a portion of it that you can leverage it to do whatever you want. But in this example, we're not. We're just going to allow this cash value to continue to build. So here we are at year two. You put $5,000 into the bucket. Your $5,500 adds an additional $5. You now have 10.5, and that money in this bucket that's protected by the 0% floor is going to make you somewhere around 5%. So we make that 5%. 5% of 10,500 is $525. So someone way smarter than me is going to take that $500 and say, I believe the S&P 500 index is going to close in a certain place. So we say, I believe the S&P 500 index is going to close at 4790, right? But if any of you remember what happened in 2022, that performance didn't happen the way we wished. In 2022, the market crashed for whatever reason. Call it January 6th, call it a change in leadership, call it Elon Musk bought Twitter, call it inflation caused eggs to be $46 a dozen. Whatever that reason is, the market crashed. Bruh. And so even though I said the S&P 500 index is going to close at 4790, it ended up actually closing at 3840. So the $525 that was used to buy this call option was lost. So that dollar amount that was spent to buy that call option at $47.90, because the market crashed, I lost the $525 that was used to buy that call option. However, the money that was sitting in the general fund, the $10,500, was untouched. So when I lost that $525, my crediting for that year was zero. I didn't make any money that year. So in 2022, when the market crashed, my $10,500 that started in 2022, I ended 2022 with that same dollar amount. Now, some of you who understand cash value life insurance policies may say you didn't really end 2022 with $10,500 because there were fees. And you're right. I'm not accounting for the fees. We can talk about fees when I get through this example, but you're absolutely right. 9 times out of 10, there were fees taken out of that dollar amount, which means it was less than the $10,500 I started with. But here's the key point. Compare this to your 401k. Compare this to the fees that came out in your 401k and the market crashed. Compare this to your IRA and the fees still came out and the market crashed. Did you get double hit, or did you only lose what was in your IRA or your 401k as it relates to fees? My gut says you probably took that 27% negative performance that was shown here. I got hit by zero. Inside that IRA or that 401k, you got hit with the full 27% probably, which means you lost far more, which also means your amount of time to recover just to get back to where you left off is pretty significant, right? So at the end of 2022, we ended right where we started, which was 10.5. All right. So here comes year 3. And year 3 is a pretty special year. What happens in year 3 is unique to this product. Year 1 and year 2 is no different than any IUL. If you wanted, it's speaking to Connie's daughter, if you wanted to accomplish what I just shared with you in year 1 and year 2, you could get that from anywhere. You go to any, I'll call it mass mutual life insurance company, get yourself an IUL, make sure it's properly structured, meaning you wanted max funded option B, make sure it's properly structured, and you could accomplish the same thing that was accomplished these first 2 years. What I'm about to walk you through from year 3 forward cannot be duplicated. At least I've yet to see it duplicated anywhere else other than a premium finance strategy. Google premium finance strategy. Premium finance strategy is a strategy that those who have a net worth of $5 million or more are able to participate in. So what I'm about to walk you through is very unique. There are very few places you can get a strategy like this. Again, any IUL from any other life insurance company, you won't see it. It's not even allowed. That may change, but as of today, that's what that looks like. So here we are in year 3. What happens at year 3 is there's a certain amount of leverage. There's a relock. There's a match. There's leverage. Let me slide over. There's a participating loan. Regardless of what it's called, all of these are saying the same thing. Relock, retirement equity line of credit. It means we're going to take a line of credit. We're going to leverage a line of credit from the life insurance company, add that to your policy. Match. It's to correlate with the 401k. You understand what a match is as it relates to 401k? There's a certain dollar amount that's going to be added to your policy, and we call that a match. But in truth, it's just leverage. It's just the participating loan. It's the same participating loan that if you have a whole life policy, if you have a universal life policy, or if you have an IUL, it's the same participating loan that you're able to use at any point inside your policy. But what happens inside of this one is because you've contributed to your policy consecutively in year 1 and year 2, you're able to leverage all of the cash value from year 1, borrow it from the life insurance company, and put it into your policy as premium. So again, I want to say that again because this is the part that makes this process unique. I didn't borrow $5,000 from the life insurance company and go do infinite banking. That's not what I did. I borrowed $5,000 from the life insurance company and put it back into my policy as new premium. Can you do that with your infinite banking policy? If you cannot, ask the question why. Don't ask me why I can. Ask the question why you can't. Because all I'm doing is taking leverage that you have access to and putting it back into the same policy. Why aren't you allowed to do so? Because I think if we ask better questions, we might actually get to a better solution because there's a win-win here. So Borrowing $5,000, putting that back into your policy as new premium. So what does that mean as it relates to the performance of the policy itself? Well, if I add 5,000 of leverage plus my 5,000 at year 3, what is happening here? Well, my 10.5 that I had left over from year 2, I'm adding an additional 5,000 of my premium into this bucket, which is protected by the 0% floor. But in addition, I'm borrowing 5,000 from the life insurance company. And I did say borrow. And borrow implies there's a cost to borrow. Borrow implies that I have to pay something back. Borrow implies that there's an interest rate being charged. All of that is theoretically true. And I will walk through what that ultimately means. But just so we're clear, the amount of money inside of your policy has just increased. It's not only increased by the 5,000 you've added, but it's also increased by the amount of leverage that you've included, that you've borrowed from the life insurance company. So inside this bucket, there are $2 amounts working for you. There's your contribution, and then there's the amount that's been matched, or the amount that's been leveraged, or the relock, or the participating loan that has come into this policy from the life insurance company. And just so we're clear, this is a brand new dollar amount. This is not you're taking some of your, I'll call it death benefit and adding into this policy. Nope. You are borrowing $5,000 from the life insurance company. The life insurance company is cutting you a brand new check of $5,000, and they're actually using your cash value as collateral to do it. But it's a brand new $5,000 that's going into this policy, which means the total dollar amount working for you is $20,500. That's the total amount. So remember how we ended year 2? We ended year 2 with $10,500. We are now starting year 3. If you were to add this together, we're now starting year 3 with $20,500. Ended year 2, $10,500. Starting year 3, $20,500. Notice the correlation. Your account doubled in size. Show me the IUL that doubles in size at year 3. Show me the whole life policy that doubles in size at year 3. Show me the 401k that doubles in size at year 3. The answer to all of those questions are, they don't. That's what makes this unique. When your cash value doubles in size, that means you have more money working for you. If you have more money working for you, doesn't that also mean there's an opportunity to make more money? And that's what makes this process unique. That's what separates this process from all other cash value life insurance policies. That's what makes this process different than infinite banking. Because again, you're taking that participating loan. I didn't run out here to go pay a bill. I didn't run out here to recapture the interest that I spent on some product that I bought. What I did was I took that participating loan and I put it in the policy. And when I did that, I've got 2 different dollar amounts working for me. So let's talk about those 2 different dollar amounts. So we're going to make, on average, 5%. Again, the dollar amount is protected in this bucket. The amount is going to grow around 5%. So 5% on this, what is that, 15,500, and about 5% on the 5,000 that we've leveraged. Well, my money makes about $525. Someone way smarter than me is going to use this $525 and go buy a call option. And then the 5% that I made on the $5,000 that I borrowed is about $250. So these 2 dollar amounts are both going to be used in the same process to grow more income for me. So what's going to happen? Just the same thing that happened last time. We're going to go buy a call option. So we're going to use the $250 that we leveraged, and we're going to use the, what was it, $550 that we based off the 5% or the growth on my money. So we're going to use both of those dollar amounts and buy a call option. And this is 2023. This is the actual performance in 2023. So if that actuary said, I believe the S&P 500 index is going to close at 4,000. Well, what actually happened is the S&P 500 closed at 4464. That's an increase of 16%. So in 2023, when a call option was bought, there was additional growth made. And so what happens is now my money specifically, is going to make on average 7%. And the money that I borrowed, that $5,000, 250 of it was used to go buy the call option. Call option did well. That means the money that I leverage, the borrowed money, is going to make the same 7% on average. This specific example, it actually made 10%. So it was actually more made, but let's just use the average. So when I make this 7% on the borrowed money, and I make this 7% on the money that I've contributed, what do I do with it? Well, it all goes back into the bucket, right? My 7% goes back into the bucket. No harm, no foul. There's nothing stopping it. But that leveraged money, though, because I did say leverage, I did say borrow. That borrowed money that made 7%, I got that borrowed money at a cost. That cost was 4%. So if it cost me 4% to borrow that $5,000 from the life insurance company, and I just made 7%, once I pay back the life insurance company the 4% that I owe, oh, it's already here. Once I pay the life insurance back the 4% that I owe, and that minus is there intentionally. So I am subtracting 4% from the 7% that I made. So I'm subtracting 4% from the 7% that I made. Once I pay back the 4%, and I'm going to digress for a moment. When I borrow money from a bank, actually, let's say you borrowed money from me. You borrowed $5,000 from me. And my only rule was you owe me 4% on that 5,000. So you took my 5,000, did whatever you wanted to do with it. Made 7%, made 15%, made 100%. Who cares? But as long as you paid me my original $5,000 back, plus the interest that you owed me, what's the likelihood of me allowing you to borrow that money again? Can we agree that if you made good on the agreement that we had around you borrowed money from me and you paid back the principal and the interest that you owed, the likelihood of me allowing you to borrow that money again would be pretty high. And that's exactly what's happening here. So that 5,000 that we borrowed, we made 7. We paid back the life insurance company the 4% that we owed. And just so we're clear, when we pay back that 4%, it goes into the bucket on top of the 5,000 that we borrowed. And notice, I only paid interest. I didn't pay principal and interest because I don't owe principal. So you may be wondering, how is it that the loan becomes self-collateralized if I don't pay back principal and interest? Well, you have to think of it this way. That $5,000 that we borrowed from the life insurance company, where is it? Is it in your pocket? Is it in your savings account? Can you physically touch the $5,000 that you borrowed? And the short answer to that question is no. That $5,000 that you borrowed is sitting in a bucket. It's sitting in here. And what we know about this bucket is there is a 0% floor on the money that's in that bucket, which means there's a contractual guarantee that you can't lose it, which means the $5,000 that you borrow from the life insurance company, you don't even have. And so when you make 7% on that 5,000 and when you pay back the 4% that you owe, that loan just became self-collateralized because the principal, the life insurance company already has. All they're missing is the 4% that you owe. And the minute that 4% is owed, the loan becomes self-collateralized, which means I can take it again. So my apologies for digressing. So pay back the 4% that's owed, the remaining 3% is yours. So what that means is in year 3, and I'll write it. Let's see here.
You want to go full?
3, go ahead.
You want to do the full board so they can see?
No. I mean,
okay.
You're the producer. You tell me what you want to do. But in essence, what's happening here is your 15.5K is making 7% on your money, and it's also making.
Yeah, let's go. I don't know if you're on the half. I'm going to move it to the full because that way they can see the whole thing.
Yes, ma'am. Told you, gotta let the queen work, man.
You gotta push it over.
I got you.
You're welcome, you guys.
So what happened in year 3? So in year 3, let me get back to the laser. In year 3, your 15.5 made 7% on your money, right? 7% on your money. And it made 3% on this leverage money. So if you were to apply this to a traditional IUL, you could have potentially did this part, right? But this part wouldn't have existed. So at a minimum, this is where this strategy starts to separate itself from other cash value life insurance policies at a minimum. Like it, don't like it, agree with it, don't agree with it. But this is the part, this is the step where this policy, this process starts to separate itself from traditional life insurance policies.
And why does this do this and others don't?
That's a great question. And I think that's where you kind of have to go back to the guy that actually had the balls enough to walk into a life insurance company and say, hey, I think we should be able to do this. I really don't have an answer to that question. I think the short of it, though, is the mutual life insurance companies that we partner with for this process see the power in leverage. They see the power in secure, uninterrupted compound interest. They see the win-win. Because in order to do a process like this, again, I use these words loosely, but they really do have meaning. Max funded, option B, IUL with leverage. That really does have a really strong meaning as to how this strategy is done. Max funded is saying we're purchasing the least amount of life insurance legally possible. Well, if I'm a life insurance guy and I work for a life insurance company and I'm selling life insurance, don't I make my commission based off how much life insurance I sell? So wouldn't it be my responsibility to my broker dealer to sell you as much life insurance as possible? But you're telling me in order to do this process, we have to purchase the least amount of life insurance legally possible. Well, if I'm purchasing the least amount of life insurance legally possible, that means my broker dealer is actually making less money to start. So it starts with a broker dealer or a life insurance company that is willing to take less upfront for the win-win in the future. And the win-win is leverage. If we securely put money inside the general fund and we're both making money off of it, because notice I made 3% off that 5,000, but the life insurance company made 4. They're already making more than me. So the win-win is they will eventually make the income that they want, but up front, they have to be willing to take less to start. So again, I don't know if that answers the question, but that's ultimately the reason why.
Yeah, because it just seems like there's other people that are saying like, oh, all this is, we can do this. We can do this. And
this
I think
is just an IUL. I can do this for you.
And I think it would be like believable if somebody who you was in your camp, right, in your church, in your kids' sports parent squad, like somebody who is in your circle, in your community, who you trust, you look up to, they're an expert at what they do. You're not going to have to go get your life insurance license just to be able to buy a life insurance policy. Like, why should you have to? Right. However, sometimes it's just they don't know what they don't know.
Right.
And I think that's important, that it's not that everybody out here is trying to scam everybody. It's that they just don't know what they don't know. And for a lot of them, they're hearing the rumors or opinions of other people. Why would they want to do this? Like, to your point, if they're not making as much money doing this and they're thinking of themselves first, then why would they want to learn to see the value? Because they could be doing this for themselves too, right?
Absolutely.
Yeah, we've got a lot of questions, so I want to get into that. Are you at a place where we can do that?
So we absolutely can. Just so we're clear, so we're in year 3. All I was going to do is jump into year 5, because in year 5, something special happens. But we can save that special happening. Right. We can save that until after a few questions. Let's jump into the questions.
Okay. All right, Mr. Stidham. Save a little something special for later.
Cliffhanger. Dun, 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 dun.
Okay. Christy says,
hey, Christy.
I would love for Donnell to do an example for a 50-year-old, including what a good amount would be to jumpstart and how much to put in monthly to retire at 65 to 70. Now, hold on a second, because Miko on the last live, he asked the same question. I just posted him in here. Mm-hmm. Is there a reverse velocity banking for someone closer to retirement and starting late? Trying to see if this is a tool for me. This was probably the number one question asked. And I think it's worth you giving, you can share what you want, but I think it's worth answering with in full.
Your words.
Yeah.
Say your words.
We started late. And so is this something that is a good fit? Is this a tool that'll work for somebody who's closer to retirement? Is this something that even if you're in a situation health-wise where you can't even get approved for a tool like this, because not everybody who wants one qualifies, right?
That's right.
Is this something that regardless of your health or your age, that even if you're later in life, can this work for you? The answer is maybe. The answer is yes for some people. The answer is it depends on the variables that you have to add to the equation, because if the math has to math, and that's really what it comes down to. We're can't sell a dream here. You know what I mean?
Right. And here's the short of it. I don't know if this is short, but here's the short of it. I guess as an analogy sake. We as 50-year-olds, right? Because I'm 52, not 52, but I'm 50.
Yeah.
We as 50-year-olds, we don't have as many compound cycles as Abel, right? Abel can take $5,000 a year, put that $5,000 away, and as we've stepped through this example over the last three lives, we have proven that Abel can put himself in a position to where he can retire comfortably early, right?
Yeah.
Well, let's take a 50-year-old and let's jump into the calculator and let's use the same dollar amount as Abel. So 50-year-old.
Oh, well, hold on. We got to go to the calculator.
Yeah, I knew you would. So let's
They
say
got to be able to see it better. That's why. There you go.
let's say
I'm here
the
for you
same
guys.
50-year-old. Let's say the 50-year-old did the exact same thing that Abel is doing. Abel is taking $5,000 a year and putting it away. And he allowed that $5,000 to compound for 10 years. So let's allow this $5,000 a year to compound for 10 years. That's $417. So if we allow that $5,000 a year to compound for the next 10 years, if you remember Abel was buying a life insurance policy of somewhere around $250,000, right? Well, the difference between Abel and us as 50-year-olds is only the fact that it costs more to insure us at our age. So if we're wanting a similar or close to the same amount of life insurance that Abel was able to receive, then clearly we have to do something more than $5,000 a year to be able to achieve $250,000 in life insurance. So that's number one. Number two, if you remember, Abel at 10 years, this dollar amount was $73,000. So it's close, but it's still off by about $6,000. Why? That difference is purely related to the cost of insurance. We are older, so therefore it costs more to approve us or qualify us for life insurance. There are more fees inside of a policy for a 50-year-old than it is, meaning the dollar amount, than it is for Abel, who's 25. So it's just a mathematical equation. So if the goal is to be able to achieve a similar goal for a 50-year-old, we have to come into this equation understanding this. We don't have as many compound cycles as Abel, and the cost of insurance is more. So therefore, we have to be a bit more aggressive. So $5,000 a month may not be efficient or sufficient for us. So what would double that amount look like? What would triple that amount look like? What would quadruple that amount? Is there a lump sum? Because we're 50, we're a bit more seasoned. We've got maybe a larger savings, or we've been doing this for a longer period of time. So we don't make $50,000 a year. Maybe we make $100,000 a year. So that just ultimately means we have to apply more upfront, or we have to be more aggressive on a monthly basis to be able to achieve our goal. And it all starts with, what's the goal? The goal isn't just to be able to do what Abel's doing. There's an income need here. What is your income need? As a 50-year-old, maybe that income need is 6 figures. I need to at least have 6 figures by the time I hit 65. Okay, so let's do that math. If I put 65 into this equation, and I use the same $5,000 a year, right?
All right, we'll wait.
By age 65, I would have $16,000. This is not 6 figures. So what does this number have to look like, or what does a lump sum contribution have to be in order to achieve that goal? If the goal is 6 figures, because again, everyone's goal is different. So if your goal is 6 figures, we can just simply back into what this number needs to look like. Maybe it's, again, I'm just making up a number. Maybe it's $2,000 a month. It's not. So if that's 76, I need a little bit. So I'm going to call it 3,000. Okay. So putting away $3,000 a month by age 65 would allow a 50-year-old to have a 6-figure income every year for the rest of their life. Maybe at 50 years old, $3,000 is not a realistic dollar amount for you. Okay. Maybe there's an opportunity for you to put in a lump sum. So we can play around with what a lump sum would look like for a 50-year-old, in addition to some type of monthly amount, to be able to achieve that goal. It all starts with the goal, and it ends up being a mathematical equation. This is something that you can play with as well. You don't need me to determine what this would look like for you.
Right.
You have access to this same calculator. And because ultimately, once you identify what that number would be, and I could hear my wife in my head, but what about inflation? That's 115,000 at age 65, but does that 115,000, is that really 115,000 at 65, or does it need to be another dollar amount? Again, we can absolutely apply those rules into this process as well. But my point is, you have to start somewhere, and really it's about the strategy. So if you understand the strategy as it relates to Abel, then you can understand how this strategy applies to you. If for Abel, $5,000 a year allows him to be able to fire his job by the age of 55 or whatever that time frame would be, what does that mean for you? Clearly, it would at a minimum have to be double because you are twice his age, which means the cost of life insurance is going to be higher for you. So we can mathematically determine what that would need to look like for you to be able to hit your goal.
And here's the part that's loaded in Jeff's question that he asked at the beginning of the stream. If you missed it, Jeff asked us, what was our aha moment that started us on this journey? How did our mindset shift? What was the catalyst for this to happen in our lives and for us to learn all of this stuff? So we went over that in the very beginning. So you can rewind and check that out if you want. But the point is that what is happening here is, in working backward, you also have to work in, it's not, can you do this? It's how do you do this, right? It's not, can you put in twice the amount Abel has to because that's what you need to be able to do to hit that number. It's how can you do that? And
what adjustments do I need to make in my lifestyle
to
make this true?
That's it. And it may be uncomfortable, but can you imagine how uncomfortable it will feel to not have enough? Can you imagine how uncomfortable it will feel to go 10 years from today and look back and say, all I had to do was, right now it seems like it's hard. Right now it seems like a sacrifice. Right now it seems like it's difficult. But imagine being in a position where you cannot. It's too late. Right. For a lot of us.
Because at age 65, it's too late.
Right. Oh, exactly. Okay. April had a question, and it's right. You were almost there. So I just want to bring it back up. I want to supercharge wealth creation. Show us what 100K for Abel would look like for Abel.
For Abel, not a problem.
Yeah. So Abel is 25, right? Mm-hmm. So April, if you're 25, that would be great. Or you could just see what Abel does, which is perfect. And that's, I think, why a lot of people like these examples is because they're not emotionally tied. It's not them, right? It's Abel. And I love that. And somebody even said that in a call, which I love that. I love you for that feedback. And you know who you are. The 2 lump payments with the permission from the insurance company. So does he qualify for this, right, is essentially the backside of that question. Right. Does he qualify to do this? Can you just put however much you want into a policy? I mean, all of these are really great questions.
Yep. And I stepped through this over the last few lives, so I'll just highlight it here. You cannot just arbitrarily put what you want into a policy like this. You do have to qualify. And based off your age, there's a certain dollar amount a certain amount of life insurance that all of us, based off our age, there's a certain amount of life insurance that we all qualify for. And in Abel's case, he's 25. Because he's 25, his max insurability is 40 times his income. So if Abel makes 50 grand a year, 40 times his income, 4 times 5 is 2. So that's $2 million of life insurance is what he qualifies for, regardless of whether he has a policy with me, a policy with Transamerica, a policy with Prudential, a policy with State Farm. He can have as many policies as he wants. He just can't have more life insurance in total than $2 million. So for April, and knowing a little bit about April's story, I believe April's a little bit older than Abel. So if we were applying this to April, what is April's max insurability? Well, it depends on your age. If you're in between the ages of 40 and 50, then that max insurability is 30 times your income. If you're in between the ages of 50 and 60, then that max insurability is 20 times your income. And it gets lower and lower and lower depending on how old you are. And so in this case, if Abel was to put away an additional $100,000 lump, and just so we're understanding, just so we're clear as it relates to this calculator is saying this $50,000 is being split between year 1 and year 2. So it's just how this calculator functions. I can build it so that we can get all $100,000 in year one, but this calculator is automatically assuming we're splitting this to 100,000 in half, 50,000 in year one and 50,000 in year two. If we allow this policy to grow for the next 10 years, what does that look like? Well, he would be in position to have about 31,000 in tax-free income. He would create he would have put in about 150,000 over that 10-year period. He would have leveraged about over $500,000 from the life insurance company. He would have access to about 267,000 in cash value, and he would have income of about 31,000 tax-free that he would be able to access. Well, how much life insurance did he purchase? Well, and remember the max insurability? The max insurability for Abel, 40 times his income, $2 million. This is saying he'd be purchasing about $2.8 million. Well, here's what we know. We know Abel would not have been able to put in all 100,000 because that put him over his max insurability. So we would have to reduce that 100,000. But if we were talking to April, and maybe April has more income, and based off April's income and April's age, maybe April would qualify for this 2.8 million. So we would be able to put in the $100,000. But just so we're clear, in this scenario, Abel would not qualify for all of putting all of this income in. So what we would do is we would restructure that 100,000 so that we can get the maximum in. And then that remaining amount, maybe we held it until he starts to make more income with the job that he has. Or maybe Abel has insurable interest. Maybe he's 25 and he's got a little one. Or maybe he's married. Maybe he has a significant other. We would use that dollar amount to be able to max fund or grow those policies. So we would still get that money to work. We just may not be able to get it all inside this policy. And you run this out further. So that's after 10 years. What does this look like maybe 10 years later, by the age Abel of being 45? Well, we have now placed Abel in the position, because of that lump sum, we've now placed Abel in the position to where he could decide whether he even wants to continue working or not. He's got $100,000 tax-free available to him. And again, it's because that lump sum jump-started his policy. It's because that lump sum put him in a position to where he can now access that money or access that cash value sooner, which means he's producing more income earlier, which places in a position to where he could potentially retire early.
And a lot of people are probably going like, okay, so this is hypothetical, just $100,000 for a 25-year-old, but
willy-nilly.
Remember that we are upon the largest transfer of wealth because of how many people. It's just, I don't want to talk about it. Nobody wants to talk about it, but it's true. It's fact that this is about to happen. All of these people, including their boomers, their grandkids, and their kids, are about to have, because they have life insurance policies, right? More of them do. More of them have larger assets. What? Because they bought these homes, they bought this property, whatever that was, and they have multiple. A lot of them have multiple, right? They were the Carlton Sheets. They jumped in, no down payment. They were out there buying up houses for like 7 raspberries back in 1970 or whatever. You know what I say? This is the same generation that ate meat and Jell-O together in a casserole in a mold. And we're going to get more into that on Wednesday's stream in talking to your family about wealth and their responses and who you're talking to. So that's coming up, just so you know, okay? Point is that a 25-year-old having $100,000 or access to $100,000, unlikely. However, if this is somebody who is trying to imagine how they would establish their trust, or how the rules inside of their trust could absolutely be that it's a little different if this person, not just the income that they have, but the assets that they have, then that becomes all a part of the equation. So it is a little bit different when you're talking about transfer of wealth versus I just won the lottery and I got $100,000. Like, this seems unrealistic. It's not going to be that unrealistic, but it's going to feel unrealistic is when you watch the amount of wealth that changes hands in this next 5 years, this next decade, and you watch how much of it is completely wasted because they just simply didn't know what to do with it. and it goes on the stuff and it goes on the things, and they think that this means that success, and they think that the boat and then the bigger house and all of these things means that they're going to be able to transfer this down to their kids, only to learn that the majority of people who transfer actual physical assets to their kids, their families, end up selling them, liquidating them anyway.
Right.
Oftentimes for a portion of the cost. So this is a smarter way of doing it. Is this unrealistic? Right now, probably for a lot of people, but for some families, it won't be. And I think that is a question that just came up recently for you, Donnell, was what happens if your parent has passed away and you have been the beneficiary of a death benefit or a policy, and now you have this lump of money. What is it that you do with it? How can you implement it into a system like this, and what would you suggest? So I think that instead of you going through, because we have a lot of questions, I just wanted to mention that because I do think it's a good example to go through. However, I want to mention to everyone who's watching right now, if you're hoping to get the answer to that, like, yes, I have a situation, I have a parent who will be, like, I will be receiving some wealth, I will be inheriting a large sum of money, and I don't know what to do with it. I am looking for how can I structure this for not just me, but also probably for my kids, my family, make sure everyone's covered. Calls with Donnell are free. They're free. And you can jump on and give him all of the variables to your equation and ask him, can you do this? Can you help me solve this puzzle? Or at least, can you tell me what it is that you would do if these were the variables in your equation? And that is exactly what you do all day, every day. So we could put the number up or the website up so that you can jump in and ask those questions there and book a call and get in soon, because sometimes it does book out for, especially with the holiday coming up.
But I
we have
want
to take some
to
days
just
out.
highlight one point here, because again, you said it, so I have to say it.
Okay.
Is this realistic? Actually, it absolutely is. Because think about it. Let's use April, for example. Let's say this is actually April's son. Right? April has insurable interest, which means she can assist her son in building wealth.
Yeah.
And maybe April has a trust. And this trust is looking to own policies on the descendants from April, Abel being one of them. So can the trust fund a policy on Abel? Yes. Can the trust, implement or add a lump sum, maybe not the total 100,000, but some portion of it, so that the Abel becomes max insured? Absolutely, it can. And with the income being generated that rolls up to the trust, be available for all of those who are descendants of, or co-owners of, or co-trustees of that trust, and be able to be used as income for the duration. Absolutely. So this is absolutely a vehicle or an example that is a reasonable, and that I've done a few different ways as it relates to building generational wealth or creating a family bank. So this is absolutely something that's doable.
Oh man, and we got a super chat. That's what's up. But he knows the rules. Yeah, he knows the rules. You put a super chat in, you get to skip the line. I don't know. It's like a live stream thing here on YouTube, so we're just gonna go with it. Thank you so much for that. Really appreciate that.
That's awesome.
Yeah, that's pretty awesome. For what's the process of withdrawing money for bills? So there is a couple of questions around this, like how are the funds treated inside of the policy when you're using them for bills? There's a couple of questions around this, but let's start here. Let's open up the gate with this question.
Yep. And it all starts with assuming that there is cash value available for you to be able to use for bills. So what that means is you funded your policy, and it's growing efficiently enough to where you now have cash value that you can leverage to pay bills, do infinite banking, do whatever you want. So what is that process of going about it? Well, here's the truth. Life insurance companies are not known for distributing income. Banks are. So we are in the process of educating life insurance on how to distribute income. So here's the way the process works today. You would go into your online account. You would click on some part of the drop down and take a policy loan. So you would borrow against your cash value to be able to go pay those bills. And you would simply fill out a form, and the life insurance company doesn't care why. All they care about is the process. And that process is filling out a form, so a manual form as to how much you need, when you need it. And in 3 to 5 business days or 5 to 7 business days, that money would be transferred into your checking account. So you would have to link your checking account to your online account. Now, as this process evolved, again, we're teaching a life insurance company on how to distribute income. So when I am in a position to be able to retire, hopefully the process looks like this. You would actually put in what that process would be as far as how you would want income distributed into your account. Maybe it's monthly, maybe it's weekly, maybe it's biweekly, but whatever that process is, you would set up that schedule of how income is now contributed into your account. And then on that schedule, on that date, whatever that day of the month is, that dollar amount will be transferred into your account. So you would be able to use it just like any other checking account. But as of right now, it's pretty manual. So you would have to fill out a form, leverage, borrow against your policy, and you would then receive that income into your checking account, and you're able to pay those bills. Now, the second half of that question is, well, if I'm borrowing money from my cash value, that implies that I must have to pay that dollar amount back. Well, it really depends on when you're leveraging that money, when you're borrowing against your cash value, and the structure of your policy. Because the way the income is structured inside a strategy like this, that income number that you're seeing is a leveraged dollar amount, but it's being leveraged at an interest rate lower than what you're actually making inside the policy. So if you have a policy that's able to generate, let's call it $30,000 of income, $30,000 a year in income. Well, the reason that $30,000 is there is because it's strategically positioned such that it's less than the amount that's actually growing in your policy. So high level, maybe your policy is making $40,000 a year, meaning the growth on the leverage and the growth on your cash value is growing at a rate such that it's making you about $40,000 on top of your cash value. So if you're borrowing 30, but you're making 40, what dollar amount is there to pay back because you're making more than you're taking as a distribution? So therefore, your account is still growing by $10,000 every year. And so therefore, you can take this $30,000 forever and not have to be concerned about paying it back because you're actually making more than the cost of what it is to borrow that $30,000 that you're using. So a little bit more technical than probably asked, but the bottom line is you would borrow against your policy to be able to take the dollar amount to be able to pay bills.
Yep. Okay. And Valerie says, well, what happens if you make 0%?
Yep.
How do you pay back the 4% to the insurance company?
Yep. So, and again, that's the next step of what I was going to walk through as well. What happens during using ABLE? What happens if the market crashes and you owe some type of leveraged dollar amount? So I can either walk through that example, or I can high level tell you.
Oh, let's go through the example.
Okay. So if we jump over to the vibe board, I'll kind of walk you through it.
Let's go to the example. Here we go.
All right. So I'll come down.
Mm-hmm. Oh, let's do the full. Let's do the full.
Yes, ma'am.
Screen because my bad. There we are. That's better.
Perfect. So I'm going to kind of set this example up a little bit. We're going to treat it as though it's 2015. What happened in 2015? Well, the market crashed. And I'm going to treat it as though we started this policy in maybe 2013. So maybe there's two years of contribution that has gone into the policy, and there's a certain amount of leverage being used at year 3. So in essence, we've put in $15,000, so that's 3 years that we've contributed into this policy. And now at this year 3, we are now borrowing $5,000 from the life insurance company. So we've contributed, and I'm dumbing these numbers down a little bit. I know there's interest. There's actually more money. I'm not showing the full dollar amount, but I just want to make sure that you kind of just high level understand the example. We've contributed for 3 years, and we're adding $5,000 of leverage from the life insurance company. So when this dollar amount goes into this bucket protected by the 0% floor, my $15,000 makes on average 5%. The money that I leverage is making on average 5%. And these $2 amounts are what I'm going to use to buy the call option. Well, if you look at the actual performance of 2015, I take this $750 and buy this call option. I say, or someone way smarter than me, some actuary says, I believe the S&P 500 index is going to close at 2,100. Well, what actually happened in 2015 is the S&P 500 closed at around 2,038. What that means is this dollar amount and this dollar amount was both lost due to the 0% floor. But the life insurance company could care less. From the life insurance company's perspective, someone owes the life insurance company 4%. Let's do some actual math. 4% of $5,000 is $200. And that's kind of what you're showing here. I don't know if you can read it or not. But bottom line is 4% of $5,000 is $200. Someone owes the life insurance company $200. Well, there's two things that are going to happen to make sure the life insurance company is compensated for their $200, but you won't notice either one of those actions. But let me first share with you the first thing that does not happen.
Okay.
Someone owes the life insurance company $200. What is not going to happen is you aren't going to get some invoice in your mailbox that says, hey, it sucks to be you. I know you didn't anticipate the market crashing in 2015, but you now owe us $200. And here's your invoice, and it needs to be paid by December 15th. Like, that is not going to happen. There are two things that occurs. The first one is this. The life insurance company understands this process. Again, this is a relationship between you and the life insurance company. The life insurance company isn't doing this because they like you. The life insurance company is doing this because they want to build compound interest as well. So the first thing the life insurance company is going to do is they're going to defer all interest payments till you die. So what that means is that $200 that's owed, the life insurance company is going to say, don't worry about that right now. We know you purchased a life insurance policy worth $250,000.
Yeah.
So if God forbid you were to pass away right here, you passed away during a down market, the life insurance company would say, hey, you know that $200 that you owe us? Well, before your beneficiaries receive $250,346, like whatever that math is, the life insurance company would deduct $200 from that dollar amount, and your beneficiaries would get the difference.
Okay, what about the interest though? I know it's coming. I know my people. They want to know about the interest on that loan.
So let me restate it, because clearly something must have been missed.
Okay.
I put $15,000 in the bucket.
Yep.
I borrowed $5,000 from the life insurance company.
Yep.
That $5,000 made, again, the general fund is the general fund. The general fund has never not paid.
Okay.
So the 5% that was made on this $5,000 is what's used to buy the call option. The 5% that's made on this $15,000 is what's used on the call option. When I buy this call option, because the market crashed, these two dollar amounts are lost. Now, so what happened to the money that I contributed into the bucket? Nothing. What happened to the money that I leveraged from the life insurance company? Nothing. But there is 4% that's owed. 4% is the interest.
Yeah.
The 4% that's owed, 4% of $5,000.
Mm-hmm.
4% times $5,000 is $200.
Mm-hmm.
So the interest that everyone is screaming about that is owed is $200.
Forever. Does it go up?
In 2015, it's $200.
Okay.
In 2016, if the market doesn't crash, you don't owe interest.
Okay.
Because the growth on your money is going to pay the interest. In 2017, if the market doesn't crash, you don't owe interest. So the growth on your money is going to pay whatever the interest owed on the money that you're leveraging. So in 2015, based off these two dollar amounts, that interest owed is $200. There is no additional interest that is owed. So how does the life insurance company get their $200?
Yep.
Again, the first thing that's going to happen is the life insurance company is going to defer all interest payments till you die. So if you didn't die, the life insurance company just made a mental note. Hey, you're going to owe us $200 at some point in the future. Mm-hmm. Well, that's the first thing that happens. The second thing that happens is this. The life insurance company is going to say, we need to keep track of how much interest you owe us. So we're going to do what's called a ledger move. It's an accounting episode. What that means is you owe us $200. We need to make sure you understand. We keep track of that $200. So again, it's called a ledger move. I think it's LED, ledger move. So what that ultimately means is this $200 is going to be compensated for, but what's going to happen is we're going to take that $200 from here. And we're going to move that $200 from this side of the bucket over to this side of the bucket. Meaning we're going to take that $200 from here and move it over here. And remember, there's $2 amounts in the bucket. There's your $15,000 and there's the 5,000 that you borrow from the life insurance company. 15,000 plus 5,000 is 20 grand. The life insurance company is owed $200. So what's going to happen is, let's see, I'll make it red. What's going to happen is we're going to subtract $200 from this side of the bucket, and we're going to add $200 to this side of the bucket. So when we do that, what happens on this side? Well, on this side, this dollar amount now becomes $14,800. And the dollar amount on this side now becomes $5,200. But when you add 14,800 plus 5,200, what is 14,800 plus 5,200? That equates to $20,000. So if you started the year with $20,000, you just went through a down market, the life insurance company is owed $200, you move $200 from your side of the bucket to the life insurance side of the bucket. We have now paid back the interest that was owed to the life insurance company. A lot of people who don't understand this process says, but wait a minute, you didn't owe 200, you owed 5,200, right? Well, the 5,000, I never moved. The 5,000 has been sitting in this bucket the whole time. So I don't owe the life insurance company 5,200. I owe the life insurance company 200 because they already have their 5,000. So when I move $200 from this side of the bucket over to this side of the bucket, I have now satisfied the interest. I have now self-collateralized this loan. And what that means is when the market recovers, meaning this is 2015. So in 2016, when the market recovers, I still have the ability to make 7% on my 14.8, and I still have the ability to make 3% on my 5,200. So notice, even though my $200 is sitting on this side of the bucket, I still have the ability to make money inside my policy, even though my $200 has moved from one side of the bucket to the other. So that is how you compensate for a 0% floor.
That's a lot of stuff.
Damn, son, where'd you find this?
Because a lot of people say this is why it will implode, right? All of the naysayers or the people who have an opinion about this particular strategy, this is the reason why they say don't do it, is because
let me
of
help
this
with that.
inside of there.
Let me help the naysayers.
Okay.
Let me get on the naysayer side.
Let's
Because this is what
get
they're
on
assuming.
it. Okay.
They're assuming that this $5,000 right here
Yeah.
is not inside the general fund. They're assuming that this $5,000 is in your pocket. So imagine the market crashing. You've got $5,200 that you owe the life insurance company. Where are you going to get $5,200 from? Because if it's not in the general fund, they're going to want their money. They're not just going to want principal. They're not just going to want interest. They're going to want principal and interest. Where are you going to get $5,200 from? Has to come from somewhere. So 9 times out of 10, it's going to come out of your cash value. And if that's the case, if you have if you have 15,000 in your account and you have 3 consecutive down markets, you're going to owe $5,200 each time that occurs. Again, I'm just making up numbers. By year 3, you're out of money. So you're right. This process can implode if you're not structured properly. If that $5,200 was in my pocket, there would be a high level of concern as to how am I going to pay back $5,200. But that is not the case.
Is this similar to, or how is using a whole life? Because there's a question here. So we'll knock a couple out with this.
Let's do it.
One was, can you do an example or a scenario where the gain in the policy is less than the loan interest rate? Policy earns 3% and the loan APR is 4%. Will the 1% cost accrue from the and be subtracted from the death benefit, or is it taken out immediately? And I think what they're wanting to know is, can you do this with a whole life policy? So how is this different? And I think that's the confusion that a lot of people have around this, is they want to be able to say, if this is a strategy, then let me apply it to another vehicle, right?
And that's where we're learning how to ask the right questions. Because I believe that's the right question to ask. Meaning, it's not that this can't be done here. The question is, why can't I do this with the strategy that I have? And where does it start? It starts with structure. So let's say you do have a whole life policy and the growth inside the policy is 4% guaranteed. but the cost of you to leverage the money inside your policy is 6%. Well, if you were borrowing money from your policy and you were able to put that money back into your policy, it's costing you 6% to put back into a policy that's only making 4. It's costing you 6% to put back into a policy that's only making you 4. So it's costing me negative 2% every time I put money back into my policy. Like, that math does not math.
Well,
no one will allow you to be able to do that. So will a life insurance company allow that even to be possible? They wouldn't, because the issue is the structure of the policy. If you were making 4%, but it cost you 3% to leverage, there's an arbitrage opportunity there. The likelihood of a life insurance company allowing it, I think, would be highly likely. But because of the structure of that whole life policy, you would have to structure the policy such that it's max funded, option B, and the cost to leverage your money is less than what the potential that you have to grow. It would have to start there.
Okay, what about the 0% floor? Because you're saying here, if it's 0% floor, if you lose, then that year it's costing you 4% more than
Negative
what you
4%.
gained. Yeah.
Negative 4%.
Yeah,
And-
exactly.
Right. And the issue there is, okay, when you have that negative 4% because of the relationship that we have with the life insurance company, meaning that negative 4% is sitting right here. And again, there's two things that happens during a down market. One, we defer all interest till you pass. So inside of a whole life policy, we would have to defer all interest till you pass. And then as long as you account for that interest and it being a ledger move, you still have all of your money still working for you. So the question is, how long can we keep up this performance without your policy imploding? And here's what we know about a process like this. We can have somewhere around 5 to 6 consecutive down markets before this policy implodes. So your question should be, when was the last time we had 5 to 6 consecutive down markets? And the answer would be never. But we have had 3. That would be the Great Depression. That would also be the dot-com bubble. So my only response is, this isn't perfect, but at least this can handle 2 Great Depressions. Can your whole life policy handle 1?
Can it? Can your 401k? Can your real estate? Fill in the blank, right?
Right. And for those with a whole life policy, because of the guaranteed 4% growth, the response is, well, I'm not impacted by the Great Depression. You are if you're looking to leverage the money inside your policy and use it to pay bills or live off or use as income. You're making the guaranteed 4%, but what is it costing you when you go to use that money? And that's what causes your policy to implode.
Man, I will say this about the Great Depression. They made vinegar cakes. They found a way to do some pretty creative things. I know I always bring it to food, but it's just because I love food so much. Okay, I've been saying Harry for a long time, and I just want to publicly apologize that Donnell corrected me. Now that you guys have met, you let us know the H is silent.
The H is silent.
The H is silent. Airy.
No.
Airy. Airy.
Which is actually a dope name. I love saying, Airy is a dope name. I'm sorry.
Airy is a dope name. I love that. Okay, so is the call option mandatory, or can it sit in your policy to compound?
So this is an IUL. If we're talking about the premium finance strategy, the premium finance strategy is the same for everyone. This is the premium finance strategy. But if you're wanting, again, once you have your policy, you get to do whatever you want. So if you wanted to turn off the 100% participation in the S&P 500 index and switch to the fixed interest rate, you absolutely have the ability to do that, because at the end of the day, this is just an IUL, and a premium finance strategy is just a strategy. But if the goal is to build income, and if the goal is to be able to apply this strategy works one way.
Okay, cool. We got Nelson Jelly Fam. That's not how you say it either, but we decided that's the nickname that we're going to give them in the chat. You got to be in the Team Jelly. You got to be in the chat to know it. Okay, reverse velocity baking is an eye-opener, I believe. It assists those with short time horizon. Like to see an example of sorry, they're moving around, so now I have to refocus. Of stopping contributions to current 401k with outstanding loan, bring over a lump sum, past contribution be your age, be 10 times your age premiums.
So I think I understand. First
Okay,
off,
I read that like a first grader. That's not okay. Do you know what's going on here?
I think so. Because, just so we're clear, the wording is confusing.
Okay.
But I think I understand what's
Sound
what
it
we're trying
out,
to say
Angelique.
here. Ultimately, can I leverage a 401k to be able to put into a process like this, leverage that lump sum, and also, based off the 10 times your age as the bare minimum that you're able to put in. So can I leverage a lump sum from a 401k and then put that in as a lump sum, and then also do the 10 times the age premium, which is the bare minimum? So the short answer to this question is yes, you can do that, but it also depends on the dollar amount that we're talking about. And if you're talking about leveraging against your 401k, I would also want to be conscious of the cost to you as it relates to leveraging that 401k, because there is a cost there as well. But the short answer is, can you do this from a reverse velocity banking perspective and put yourself in a position such that you're able to produce income going forward? You give yourself 10 years to be able to, enables perspective, give yourself 10 years inside of a vehicle like this to be able to produce income. At some point, you absolutely can do so. And so yeah, again, I don't know what else to say other than yes, this is possible.
Okay. All right. So were you jumping into something else, or no? Can we keep
No.
keep with
So
questions?
ultimately, this is what happens during a down market. I think the only thing left is what happens at the end of 2015. And at the end of the day, the bottom line is you've got 14.8 of your own money, and you're leveraging 5,200 of the life insurance company. So you would move forward into the following year, which would be 2016 as such. So no, I don't have anything else to share there. Are there any other questions?
Yep. There's a lot.
Yeah, let's do it.
Okay. All right. Crumpler 10 asks, when you find how long it would take to reach your freedom number, at least 2 times your current income, what happens if you retire early and that means you stop contributing because you reached your freedom number?
Yep. So if we're talking about a life insurance based product like this that is producing income year after year after year, the thought process in this calculator is you are no longer contributing to it, and you're able to take that income because your cash value, again, the income that you're taking as a distribution, you're borrowing from your cash value. And the number's strategic. What that's saying is you're borrowing from your cash value, and you're borrowing at a rate less than what your policy is actually making. So the assumption is your policy is continuing to perform. How is that? Well, and I think the best way to show that would be this visual. What's happening inside your policy is this. In years 1 and 2, you were only making 7% on your money. But in year 3, you made 7% on your money plus 3% on that leveraged dollar amount. At year 5, which we really didn't get into, but at year 5, you're making 7% on your money, 3% on that money from years 3 and 4, and then you're making an additional 3% on additional dollar amount that's being able to be pulled in at year 5. So what's end up happening is you're making 7% plus 3% plus 3%. And every odd year, you add more and more leverage, meaning the leverage starts to exponentially get bigger, which is why that leveraged amount becomes so large. So what ends up happening is the amount that you're leveraging when you start to take income is so large that this looks more like 14, 15, 16% on average, because this 3% is on someone else's money. So it's not directly related to the amount that's growing on your cash value. But when you add this dollar amount together, it equates to you making more like 14, 15% on your money. So high level, just take a look. If you're taking income, which is 10% or 11% of your cash value, that's your income that you're taking every year, 11%. But you're taking, but your cash value is actually making closer to 14, 15%. You're taking less in income than you're actually making, which means you could take that income forever. How is that? Well, as these years progress, let's say you never put in another dollar amount. That doesn't mean this leverage stops. So what ends up happening at year 13, so even if you stop contributing at year 13, you still have leverage from year 3, year 5, year 7, year 9, year 11, and you're going to have an additional 3% from year 13. So the leverage continues even though your monthly or your annual contribution stopped. Because you have so much leverage in the policy, the leverage continues long after you've stopped contributing, which allows your policy to continue to grow, which allows you to be able to take this income forever, even though you actually physically retired and are no longer putting in premiums or no longer making income to be able to fund your policy. Pretty powerful.
Yeah. So Jeannie was asking, wrong question. Christy was asking, do you have to wait 3 years to start reverse velocity banking? I don't know if the question applies because this is a strategy. Do you have to wait 3 years to start leveraging your policy at the point where you have your freedom number? Because reverse velocity banking is a strategy applied to this product that will help you generate income for the rest of your life and get there the fastest way possible and be able to use your income the same way that you use your cash flow in a velocity banking strategy. Instead of rapidly reducing debt, you are rapidly increasing your wealth, utilizing your income. Did I say that right?
Sweetheart, you got it.
Okay.
And I think, let me also restate what she stated, but in different terms. Because what she's saying is, do I have to wait till year 3 to use the leverage inside of my policy as income to pay my bills?
Right.
Do I have to wait till year 3 to use the leverage inside of my policy to be able to use that leverage to pay bills? Do you have to? You don't have to. But how are you able to do so? In order to do so, the amount of money you would have to put into this policy to be able to generate enough cash value prior to year 3 to pay all of your bills would be significant. So do you have to? No, you don't. But what that would mean is you are hyper funding this policy so much early on that you're able to then comfortably take distributions from your policy prior to year 3 to be able to pay your bills. Again, I don't know that that's a realistic thought process, but the question that you ask is, do you have to? You don't have to wait, but you do have to have enough money inside, enough growth inside your policy so that you can leverage it to be able to do those things. And if you hyper funded enough early on, you could pull that off.
Yeah. Jorge, it's probably George. George, is asking about the loan interest. See, this question gets brought up so much because it's an important question too for people to understand. If you rewind, just take the scrubber, go back, like I'm going to say 10 minutes tops. You're going to be right there. And then you can just come right back and join us live after you've seen that part. Cause we just went over that, and I made him go over it like 3 times. So there's that. Okay. So that's Christy's question. Jeannie's asking a question about, can you increase the loan amount? But Jeannie, I want some context because I don't really understand, unless you know more of why people ask this question. I think it would matter. The context would matter. Now, here's what I do know. What I do know is that we get this question a lot. Can you have access to all of your money in year 1? Like you put it in, you start your policy, and you have access. And the reason why people ask this question is because this is something that is told to them by whole life insurance agents who say, yeah, and you have access to all your money right off the top. Yeah, you do. At the cost that's higher than it's growing. Cost to borrow is higher than the rate it would earn. So yeah, sure, you can have your money. We will loan you back your money starting in year 1. Absolutely. That's what the banks do. That's what everybody around you is doing. So there's no benefit to you to do that. Can you do it? Yes. You could also walk down and get a payday loan at like 22%. You can. If you want to just have a bunch of options of what you can do to get further screwed with your money and have your goal farther from you, there's a ton of options out there. But I think a lot of people get caught up in the options and they're missing the strategy. And that's the part that I want to share. Don't miss the strategy because you are so caught up with the bells and whistles. You have the car. This reminds me of our youngest who wanted the car that looked cool. He wanted the car that had all the bells and whistles. And the one thing that was the least important part to him was, does it run, right? Can you guys understand? Everybody on this live stream understands what, if they have kids, they have had to have this conversation, right? The last on the list, bottom of the totem pole, was, does the car run? And if it doesn't run, right, it wasn't even like, well, how much is it to fix it? Cars can be fixed. In their mind, it's just like, boop, you go and you get it fixed because it looks cool. It's worth it, right? It's worth it if it needs a little love. That's what they were thinking. But they weren't really doing the math on what all of this looked like, what the experience was going to be if they couldn't get to work and then they can't afford to fix it and all the other things. If he had it his way, he would have a 1987, because this generation thinks that they invented the 80s and the 90s. Right. Bless them, okay? He would have like a 1987, 1994 vehicle that he could brag to all of his friends, driving around the town, looking like a big deal. We love that for him. We loved that idea for him, that he was just going to be so proud of his first car. We all thought that, right? But then we all got the jalopy, because the jalopy was what was going to get us to school. Whatever the name was of the car, Big Bertha, whatever it is, the bucket. Yeah, the rusted bucket. We got to school and it was okay because there's kids that had the cool cars. That's fine. But you knew you found your people when you and all your friends were like, what kind of bucket did you get? Dear Liza, dear Liza. There's a hole in my bucket. It's what's the priority? And it's the get in where you fit in and make the best of what you have. And I think for a lot of people, they're looking at, do you have an opportunity where, man, I put this $50K in and I need to get it out because this house over here, this property, I have this opportunity to get this tax lien situation and I need to like secure that, then cool. Yep. That makes sense. But if the math don't math on your equation, that's why it's not one size fits all. None of these are. It's the strategy and how you're using it. And I just don't want people to get lost in that, because I do think that a lot of people have paralysis by analysis trying to understand like which is best. And I think once you see the strategy, it's a lot easier to start making decisions and forming solutions and answers to those questions.
Absolutely. And I just want to highlight something real quick. And it dawned on me in this moment that I'm doing it. I know I'm going to hear feedback on me smiling. And the reason I'm going to hear feedback on me smiling is because it may be assumed that I'm smiling because of what it is you're saying. And that's not it. I love it when you got it. And it is very clear that you got it. And the smile is from the fact that I didn't have to respond to that question at all because you broke it down. Because you absolutely, and I appreciate the fact that when we talk about where we've come from to where we are now as it relates to this subject, you see it, you get it, and you got it. And because I think you articulate things better than I do because your analogy is always better. And so my smile, just so we're clear, my smiling is around the fact that you get it and you got it. And I don't have to respond. You don't need a rebuttal from me. There isn't anything that I need to clean up because you got it, just so we're clear.
Thank you for that. And that means a lot to me because I'm on my healing journey with math. I used to say all the time, and I used to tell a story to myself that I hate math. And I just did not want to have conversations around these things. The truth was, I hated that everyone around me growing up couldn't have these types of conversations. And so they were uncomfortable for me. And so instead of I counted myself out from a lot of these. Even when we started live streaming, I was just like, I don't want to say something wrong. I don't want to be seen like I'm trying to act like I know more than I do, because I'm really in the chat with you guys for a reason. This is a lot of the stuff that you had found for us and implemented for us. I have my lane and things that equally that we contribute in that way. But man, I don't think that I would have even said that this was possible for me. My health, yeah, I was willing to get in the weeds and I was willing to dig in there for solutions and strategies, right? And try different things and learn about it, because it was something that I felt like I already knew, I already believed that I believed that what they were saying about me was was false. I believed that what was in my future, that they were not going to make those claims over me. I believed that. So that was different, right? My experience and what I believed about myself. Was I going to be in a wheelchair? Some people are, but I just did not believe that about myself. I felt like they were just passing me off, and I didn't like that. So I thought, I believe this is not my future. I'm going to move forward as if it is not and go towards that.
And there's a key piece around what you're saying there, because it also speaks to everyone's financial journey.
Yes, exactly.
Because think about it. This goes back to that comment that you made around the analysis paralysis comment. Think about it. If we spent as much time scrutinizing our 401ks, our IRAs, our 403bs, and our TSPs, we would learn that these vehicles that we have been indoctrinated into to be able to put our company and these custodians and have the full control over our retirement. If we scrutinize these as much as we're talking about this simple IUL with leverage, because that's all this is. If we spent that same amount of time digging into the 12B1 fees associated with your 401k, or the fact that your advisor who's telling you I only make a 1% management fee on your retirement, you do the math and really learn that that's actually 2/3 of your retirement. You could
19
actually
years.
only have a 401k and retire comfortably if the dude who is managing your 401k, or if you scrutinize the dude that's managing your 401k the way we're talking about this. So you're spot on, sweetheart. If we just step back and went, you know what? I want to take a little bit more control over, or take a little bit more responsibility and accountability and control over what these vehicles are, because I don't believe they have my best interest at heart. And that's what you did as it relates to your health.
Right.
You decided that, you know what? I don't believe that Mayo has my best interest at heart. So guess what? You know what I'm going to do? I'm going to take a little bit more control over what's going into my body. I'm going to take a little bit more control over what the actions I'm going to take next. And if we did that as it relates to our financial health, we would also be in a much better place financially. But we don't spend the time to scrutinize the banks who have our savings account, and we're only making 0.01% on the money in savings, but we're treating our savings account as though the banks have our back, so we want to make sure we put all of our money in it. But do they though?
Yeah.
So I think you're spot on. If we spend a little bit more time doing exactly what you did as it relates to your health, doing this associated with our financial health, we would all be in a much better place.
It's the belief part though, right?
That's right.
Because if I didn't believe that there was something different, I would have then believed them.
That's right.
At one point, one of my medications that they had me on was $1,900 a month. Remember that?
I do.
And it made me so sick. My stomach was cramping. It made me just physically in pain and sick every time I took it. And they kept telling me, just keep taking it. And I would call them and I would be like, it seems like my body does not like this. Should not be feeling like this if this is to make me better. And they kept saying, no, just keep taking it. Keep taking it. It's going to take some time.
Mayo's got your back.
You know what that ended up getting me was another medication for the side effects of that medication, and then a medication for the side effects of that medication. And they wouldn't call them side effects, but I never had any of those symptoms before we started. And then what's interesting was I got then admitted for like a 5-day study because I had so many neurological symptoms when this wasn't a neurological thing before. But all of a sudden, somebody in their 30s had what was looking like Parkinson's disease forming, and they thought it was wildly fascinating and wanted to study me. I paid for all of that, right? We paid for all of that for them to study. And they thought it was important, and it was all of these things that they said it was. It wasn't even necessary, because the minute that I stopped taking all of that medication, I started to get better. And I didn't get completely better, but some of those symptoms started to improve. And it is the control, but it's the belief part, because a lot of people are sitting here and they're not doing this with their financial health because they don't believe that retirement is a thing for them. So why would I maybe I'll be interested in it, but why would I really take the steps? Why would I wake up every day with retire early energy, right? Why would I do that if I don't believe that this is possible for me?
No one else is doing it.
Why would I wake up every morning and think generational wealth is happening because of things that I did today? Why would I do that? If I don't believe it, you're not going to do it. And I think that's the part is they call me crazy. This is the part I was getting to because I know this is all a big personal share and I'm all emotional about it. But this is the part that's important. They called me crazy. I was bawling my eyes out in this office as I was firing them because I was telling them, I do not think you guys have my best interest and I do not believe what you're saying. How is it possible that I have all of these diseases and illnesses forming when I didn't have all this when I came in here, right? How is it possible? And they said I was crazy. So they said, well, you need to go to some therapy so you can deal with how sick you are. Because that's part of the problem is that you're not coping with how sick. You haven't accepted it. And therefore, you're making it harder for your body to like accept the medications or whatever. You need to go to therapy. They'll help you cope with all of your diagnosis. And I was like, oh, is that all I got to do is just go to this therapist and then they're going to help me cope and then I'm going to start feeling better? I will do it because I want to feel better. That's the whole point. I believe I can feel better. So I'll go to anything. I'll do anything. And I sat down and they called me crazy. And I sat down in that therapist's office and they were like, why are you here? And when I tried to explain to them that I'm here, I'm willing to do whatever it takes. I am willing to do whatever it takes at 100%. Please tell me what it is I need to do. I'll cry. I will tell you my whole life story. Like, let's get it out. We will talk all about it. I'm ready to feel better because I believed this was not going to be my life. You got to believe at that level, that you are willing to do whatever it takes at 100%. You are willing to push back. You are willing to ask questions. You are willing to ask questions inside of those questions. And you're willing to educate yourself at a level that when you go to work and you're talking to your HR and they're saying, hey, here's this 401k that we're selling you, then you go, well, show me what it is that I'm going to get. Because to your point, Donnell, if we were to ask more questions about these things, then the regulations would change. So to Roderick's question, does the Federal Reserve change the interest rate have any impact to MPI? Don't you think that all of these things should be able to impact each other so that it all ends up into being that we're financially free, that we can be financially independent, that we can all be okay? All of these things should, or that we're protected. But the good news is we're protected.
That's right.
If we educate ourselves, we know also how to protect ourselves. You can answer that question, by the way. I was just throwing it in there.
Sure. And you're going to hear this from me, and I doubt you can find this anywhere else on YouTube. I'm telling you, man, I think we're different. So this is one of those strategies, a premium finance strategies is one of those strategies where we would actually prefer rates to continue to rise. Let me explain what I mean. So as of right now, the cost to borrow, the participating loan inside of this policy is 4%. It has a ceiling. That ceiling is 6%. So as of right now, because the cost is 4%, and the growth inside of a policy like this is somewhere between 0 and 10%. So that means the spread on the participating loan that you're putting back into your policy is somewhere between, if the loan amount is 4%, the ceiling on the amount of growth on the call option is 10%. That spread, 6%. Well, if interest rates were to continue to rise, that would mean that ceiling of 10% continues to rise. Well, that would also mean that ceiling on the current cost to borrow, that 4%, would rise. Well, the contractual ceiling on that cost to borrow is 6, can't go above 6. So we would actually prefer interest rates to continue to rise to cause the spread to actually grow. So, because imagine if interest rates if the ceiling was around 15%, and the max on the cost to borrow is 6, that means that spread is now 11. So we would actually prefer interest rates. So is MPI impacted by an increase in rates? Absolutely. And this is one of the few strategies that you will hear about that we would actually prefer. We would actually be okay if those interest rates continue to rise because that means the spread would get better, which means you would actually make more money.
Man. Okay, so on to more questions here. Jeannie, I didn't see your clarity on the question about the borrowing money. So just a call if you want to throw that in the chat. Okay. See, we did that one, did that. Okay, who are the mutual life insurance companies that you guys partner with? Sorry if I missed that
No,
because
no
we didn't
problem.
say it.
And I never do. There's several that we use. There's probably about 5 right now. A few of them are global. Um, Mutual of Omaha. Matter of fact, when you get time, Google Mutual of Omaha. You'll actually find that Mutual of Omaha is an A-plus rated life insurance company, been around since before the Great Depression, and they offer the #1 IUL in the country. So there's a few different life insurance that we kind of work with. And again, I'm not captured by any of them. So if I was to share an illustration up here, I can't share an illustration from any of those life insurance companies because I can write for all of them. But the bottom line is we only use mutual life insurance companies. And those mutual life insurance companies, all of them have been around since before the Great Depression. So they all do a pretty dang good job. But the main objective here is about structure. And that structure really hinges upon the amount of fees associated with this policy. So the key is to structure or design a policy such that it has the least amount of fees. Well, what life insurance companies offer the least amount of fees in their policies. And so that's the reason why we partner with only a select few. There's a lot of life insurance companies that would like to be able to participate in a product like this, but it's kind of hard to do when those life insurance companies are focused more on how much money they make off you versus putting you in a position so that you can make the maximum amount on yourself.
Okay. Shadowlick. I don't know if we're saying that right. I hate butchering people's names, but whatever. Here we go. We're just going to do it anyway. Is there an advantage to borrowing from the policy each month for bills versus paying less to the policy and not borrowing from the policy? So no different than Velocity Banking, not putting all the money on the debt tool, paying the bills, and then just putting the cash flow on the debt tool.
Yep. And I think this speaks to, there was a visual that I had put up last week, I believe, where an investment strategy compared to a wealth strategy. And is there an advantage to using leverage dollars to pay bills? I'm going to rephrase this question. Is there an advantage to using leverage dollars to pay bills versus just using your cash on hand? And it's no different than the concept around Velocity Banking. Why is using Velocity Banking better than just simply paying a bill with cash? The thought process is the same, getting multiple uses out of a dollar. Well, would it be better to use leverage money to pay bills? Because leverage money, there's no tax. So you're actually using leverage money. Let's say it's making you 7% inside your policy, but you're using that dollar amount that's making you 7% and you're paying a bill. So now your cell phone bill, the paying of your cell phone bill is actually making you money because you're using leverage dollar to be able to do that versus just taking money out of your checking account and paying that cell phone bill. How much did how much did your money work for you? Or how much did your money grow when you used that dollar amount out of your checking account to pay that cell phone bill? Not at all. So is there a benefit to using leverage dollars? Absolutely. Using other people's money to help grow wealth for you is always an advantage. That's how billionaires became billionaires, by using other people's money or leverage dollars to be able to create an arbitrage situation that allowed them to grow wealth. So yes, there is absolutely an advantage of using leverage dollars to be able to build wealth for you.
Did you guys know that Elon Musk literally bought Twitter with leveraged money? He didn't even have any money of his own, just completely on a note that said, oh, I have some things over here and I want to get some things over here. And so can you just loan me the money so I could go buy Twitter? And they were like, sure, no problem, because that is how the game is played. Did you know that your bank doesn't even have the money? When you get a mortgage, they don't even have the funds. They're at the bank. Like most people, including me, assumed that there must be $350,000 at the bank, and then they just wire it over to when you buy the house, right? They pay, and then they say, okay, now that we did that, you got to put it back in the bank, right? Mm-hmm. No, it doesn't work like that. It's called mortgage funds. It's the same thing. They're just borrowing money, saying, look, we're going to give you something, but we have collateral, so it's actually nothing for nothing. It's just a whole bunch of leverage. So if this is how big banks have been doing it, if this is how literally everyone's buying their home, then why are we not taking advantage of the same exact system but creating our own bank? Essentially is what you're doing. But you're doing it in a way that is secure. You're not leaving your family. You're not leaving your spouse with a big bill that even though the bank doesn't have the money, you still have to pay it back to them for the house, right? Or they'll take it. They don't give you your money back. This is different. And this is how wealth, true wealth, is built. And I appreciate that we are seeing an evolution of strategies and vehicles to be able to leverage so that everybody has a shot at this. It's not just for the wealthy or if you have access to this information. You're on YouTube, now you have access to this information. There it is.
And here's the thing. The whole goal of this channel is for you to be able to put yourself in a position so that you can be the bank, so that you can be the financial institution, so that you can be the life insurance company. Treat them the same way they've been treating you. Leverage them the same way they've been leveraging you. Like, what is the harm in that? And I think it feels so foreign because it's PTSD. We've been mistreated for so long.
Yeah.
We've been conditioned for so long to feel as though these banks, these life insurance companies, these financial institutions somehow care about us when they don't. So it's not that they've done anything wrong. Like, they've made their billions. Don't get me wrong. Now it's time for us to make ours. What is the harm in us leveraging them the same way they've been leveraging us? I'm not looking to do anything illegal. I'm not telling you to go set the banks on fire. It is just simply leveraging them the same way they've been leveraging us. And so again, if you're looking at this strategy going, there's no way, you're asking the wrong question. The question you should be asking is, why can't I do the same?
Right.
What is the structure that needs to happen inside of my product that I'm using so that I can do the same thing? Go get those answers. And matter of fact, share those answers, because I think if we peel back enough layers, you will find that the only reason you probably can't do it is because that means the company that you're working for would have to take less money.
And that brings me to Lolo's question. She's always got great questions. If at 59 and a half, I am still not ready to retire, would it make sense for me to draw from my Roth IRA and drop that money into an existing IUL or MPI policy?
I am all for money making its own money. So if your money is in a vehicle that is subject to market risk, meaning your IRA, your 401k, your TSP, your government 457 plan, if we change presidents, the dollar amount inside of that bucket can all of a sudden shift. My objective would be to be transitioning that dollar amount into a bucket that has less risk, regardless of who's president or who bought Twitter or what's going on. So would it make sense to take a distribution from a Roth IRA to be able to fund something else? Why not? Why not put that money to work? Would it make sense to take Social Security early and get that Social Security working for you in another vehicle if you don't necessarily need it? Why not? Why not take that money and put that money in a position so that it can make you more money? I am always a fan of that. Absolutely. Leverage them the way they've been leveraging you.
Yeah, because a lot of times people are holding out for an extra $500 a month. You're holding out for an extra $6,000 a year. And what's sad is that's for a lot of Americans, that makes a huge difference, right? Well, that's sad. We need to change that. They need to change that, really. But we have to take control and change it ourselves. We cannot wait for them to do things that are going to benefit us. Like, they're just not going to. They don't have to. How about that? They just don't even have to. So that's a nice thing if they want to come up with solutions like that. But these, at the point where more people are educated about what it is, their options, and what it is that they're doing, they are going to have to start getting competitive. They're just going to have to. Right now, they don't have to. So it's coming. I believe it's coming. We're seeing solutions like this MPI strategy, and we're going, yeah, this is just a matter of time before you can just call any insurance company and do the same exact thing. They just want to know, okay, well, IBC and Whole Life, when Nelson Nash came out with his book, there were still a lot of companies that were like, we don't want you to do that. Please don't. And then on top of that, there were a lot of people who didn't understand what happens to the cash value when they pass away. So they spent all this time building up their cash value only to find out that back in the day when they got this policy, somebody didn't know to put the rider on there to make sure that they could keep that cash value. And so they missed out on all that. Well, they're not here anymore to be like, hey, wait a second. You said they don't know that, right? They're not here. So who's complaining about that? Your family is going to get what they get, and that's all they can. They get what they get, and they don't throw a fit. That just came in my head because that's programmed in my head, right? I don't know who else. But that's the point, is that what are they going to argue or complain about at that point? It's too late. But education really matters, and that's why. Okay.
I think you bring up a solid point, though, around also, like, we sit around this forum and we throw out stuff like the Roth IRA, like it's the next best thing since sliced bread, right? But in truth, IRA started in 74, and I want to say they were working, Bob Packwood and William Roth, which were the two senators that created the Roth IRA, had been working on it since like 79. But it wasn't actually fully adopted until 1997. My point is, during that time, 79 to 1997, what were people doing?
Yeah.
They were saying they were poo-pooing on the Roth IRA is what they were doing. They were poo-pooing on the fact that this could actually be a vehicle that works. So why are we shocked that as it relates to a premium finance strategy like MPI, it's difficult to be adopted? It's difficult because we've been conditioned. We've been conditioned to believe that it's not possible. Nelson Nash said that whole life is the only way. No, he didn't. But we have shifted this narrative to fit what it is we're currently doing because of who benefits, right? But if we actually step back and just realize, you know what? Things evolve, things get better, things improve. And maybe this is just an improvement on a strategy that's always been there. It's just now available to all of us. And if we adopt it, if we implement it, and if we ask the right questions, it could actually go mainstream.
Yeah, and it needs to, because we all need access to financial freedom. It should be there for everybody. But if you weren't there for our inflation live streams, you definitely should take a look at those. You should pay attention, go to calculator.net and go take a look at what your annual income will look like in 10 years or what it needs to look like. Scary.
Sweetheart, I'm hungry.
Yeah, well, hold on. We got just a couple more and then we can go, okay?
Just letting you
All right.
know.
We have, I had to go back because I started seeing comments in here, so I had to go back and find them so I could star them and bring them up. All right. The Kelly and Jeannie, I think, are kind of in the same camp. So that's why I saved them, the two of them together. So Kelly says, are you saying you don't have to repay the loans because MPI plans are properly structured, meaning any loans or leveraged funds are resolved at death with the death benefit? Okay. So that's what she's saying.
Mm-hmm. Can we answer that now or wait till this next one?
Yeah. Well, I know you can.
Answer now? Okay. So structure that absolutely does matter. When you leverage your policy also matters. So not just the structure, when matters. Meaning, if you have enough cash value built inside of your policy such that it's producing income and that income that it's producing is less than the amount that's actually growing on your cash value, you can take that income forever, ride out, head out to the sunset, everything is fine. But if we're talking about the first few years of your policy, yeah, it may be producing, or there may be cash value available for you to leverage, but there's not really enough, I'll call it cash value generating for you to be able to take as income. So then in that case, I would suggest any leverage that you use inside your policy, you pay back because you want to make your policy whole so that you can continue building, or that wealth can continue building throughout the years. So it's really about also when you use that leverage. So does it have to be properly structured? 100%. But it's also when you're wanting to take that leverage as well. And then that's why that calculator is so powerful, because if you notice years 1 through 10, there's really not much happening there. But once you get into those years 10 through 15, 20, 30, there's some amazing things that happen inside of a product like this. And it's all just simply math. It's compound interest. It's 2 becoming 4, 4 becoming 8, 8 becoming 16, 16 becoming 32, and so on and so on. You give your money enough time to double, you give your money enough compound cycles, it turns into something that you can actually produce and use for income for the rest of your life.
Okay, so Jeannie is saying the example showed on, she was like, can you borrow more? Remember her question? Okay,
Yes.
the example showed on how borrowing from the policy and enhanced earnings. I was just curious about the possibility of increasing the amount borrowed, never exceeding the amount contributed. I think what she's just saying is, how much can you borrow? Is there a limit? Can you show if you were to borrow more in that time period? And I think that's a beautiful question. I'm going to just throw in a couple more here because I think it all kind of goes together. Tanya was saying, I've heard knowing today's tax rate is better than not knowing in the future. When is taking the hit better than waiting? I have over 300,000 in IRAs, 50. Yes, old. No, you're not. You're among your peers here.
Man, don't come at me with that old stuff.
Tanya, you are in good company here. Okay. So the reason why is because I think it's the borrowing part, right? What we're really talking about is leverage, flexibility, being able to pivot when and if you need to. And I think it doesn't matter. Roderick is asking, can you illustrate why taking Social Security earlier than later? It's leverage. It's leveraging the time now. It's saying $6,000 isn't going to help you if that money is being spent on the increase of inflation, right? What are you going to do with it? And that's what I think is most important. Tanya's going, I got 300K sitting in this thing. I've been building it up and I've been thinking that I'm doing a good job, but geez, now that I realize, now that I'm here, now that I'm 50, I'm realizing I actually needed $1.5 million to even have a fair shot if this was supposed to be a retirement account. So what do? Do I leave it in here? Do I borrow against it? Do I just take the hit? Like, what am I supposed to do now? Because I did everything that they said I was supposed to do. So Roderick, doing everything that they say that you're supposed to do, continue working, continue feeding in, and then we'll give you we'll kick you a couple extra dollars, dude, when you're older. If you just wait, like hold off. And the whole point of this whole system and why they're rewarding people in this way is because they don't have it.
Right.
They don't have it. This system was failed from the start and they don't have it. And so if you can keep pushing it off, then they can keep changing the rules too. So there's that part. So go ahead, Donna. I just want to lump all that in. It's leverage. It all comes down to leverage, control, and being able to pivot when you need to, but mainly having control over what the outcome will be without somebody else having to change the rules. That's not nice. Don't point at people, Angelique. Gosh.
I do that too, and I don't be meaning to. Like I know.
Yeah,
I
people are probably watching me like, girl, would you stop?
I do that too.
Yeah, don't do that.
So let me work backwards.
Okay.
An example around taking Social Security early, like why should you? And I'm a math guy, and just high level. Let's say you were to you got $1,200 a month in Social Security starting at age 62, and instead of waiting till age 72, where you would have gotten $2,000 a month. Again, I'm just making up random numbers. I don't know. The thought process is this: you don't know what's going to happen between 62 and 72. So if you're getting $1,200 a month at age 62, $1,200 a month times 12 is $14,400. Can you take that $14,400 and put that money to work for the next 10 years and do better than $2,000 starting from 72? That's the question. I'm a math guy. So if you can take that $14,400 a year and over that 10-year period, allow that to grow better than what $2,000 a month would do for you, 24 grand a year from age 72 till you pass. Oh, and by the way, what's the average lifespan of your average American? It's somewhere around 80, right? So if 62 to 80 versus 72 to 80, $2,000 a month, 24 grand for 8 years compared to $14,400. Yeah, $2,000 a month, 24 grand a year, $14,400 a month from age 62 to 80. Mathematically, which one accumulates more wealth over time? So to me, it's just a mathematical discussion. Now, as it relates to the leverage part. So the 300, what was it? Um, I forgot the first question.
Oh, because I threw so many in there. That was like for my neurodivergent people. They kept up with me
Hold on,
probably.
but it's coming back.
Okay.
Here's what it was. How much of that leverage can you have in the first few years? And here's the part that sounds strange for me to say, but this is where a whole life policy would actually be better than a strategy like this. You can structure a whole life policy so you have what's called 90-10 or 60-40. And what that ultimately means is if your goal is to have the maximum amount of cash value up front, you can structure a whole life policy so you can have majority of, let's call it 90% of that cash value in year one. Now, there's a cost to that. I would say if you do the cost benefit over time, mathematically, it would make more sense for you to not do that. But the truth is, if you wanted as much leverage as possible at year one, a whole life policy would do better than a strategy like this. And here's why. Inside of a strategy like a secure compound interest account, a premium finance strategy, the max that I've seen, the maximum amount of cash value available in year one is somewhere around 60%. So if you put $100,000 in year one and you were expecting to get $90,000 to $100,000 in year one of leverage to be able to use to go do something else, it's not happening. You get somewhere around 60%. That's year one. Year two, you'd have somewhere around 80-85%. But in year three, 9 times out of 10, depending on your age, but 9 times out of 10, your break-even point inside of a product like this is year three. What that means is at year three, you would have accessibility to somewhere around 98% of what you've contributed over that 3-year period because of the leverage, because of the additional support that you have inside this policy. So this is where a strategy like this will outperform a whole life policy with its eyes closed. But if we're talking about year one, the maximum amount of liquidity in year one, you could probably get a whole life policy that could do better. But long term, and again, my focus as a retirement consultant is about the long-term growth, your ability to be able to access this dollar amount for life. I've yet to see a product that can beat this. And I think there was also a question in there in the middle around $300,000 in an IRA. What should you do? I'm a math guy. Does it make sense to take the tax and penalty hit below the age of 59 to leverage some of that money to put in a product like this? I cannot justify taking a tax and penalty hit on $300,000 to be able to do it. But if you're at retirement age and the dollar amount that you're going to leverage inside of that retirement account is going to be taxed anyway, and if you take that income early to be able to not only use it to be able to live, but to take a portion of that to get in a secure compound interest account that's going to produce a lifetime of income, I do it all day long, but I would go back to what does the math say? So I don't think it's something that I would just arbitrarily do. It's something that I would do based off what the math said.
Yeah, and her follow-up was, based on this knowledge, I'm willing to take the tax hit today. I love that, today. But I've heard Donnell discourage taking the hit and maybe look at annuities instead.
And that's just it. So annuities, and you bring up a great point. And again, this is something that I have to do a better job at communicating. But you're absolutely. Let's use that $300,000 as an example. You got $300,000 in a previous employer's plan, and you want to put it to work. Are there annuities out there? Is there a growth annuity that I could put that $300,000 in, and you tell me your time horizon is 10, 12 years? Is there a growth annuity out there that I could put this $300,000 in that would give you a significant return over and above taking that tax and penalty hit? Hell yeah, I can do it. I'm telling you, there's some annuities out there that can perform very similar to a secure compound interest account with the exception of the leverage. So if you can not take the tax and penalty hit, get this money into an annuity, and a growth annuity that can outperform what taking the tax and penalty hit on that dollar amount and putting it inside of MPI, I think it would be a comparable performance. As a matter of fact, I would even venture to say it's possible that in a short period of time that annuity could actually do better, because again, the time horizon is shorter. MPI takes longer time for it to be able to produce the income that you want. So because of some of the incentives that these annuities have out there that would allow you to be able to produce income faster, man, I'm telling you, I think moral of the story, everyone is different. So the best thing that we could do is sit down and discuss and talk through what that math actually looks like. Because in this case, it may make more sense to do an annuity over taking that tax and penalty hit.
Hey. Okay. Drew says, would be really curious to see a couple of in-force illustrations over a few years to get a better understanding of the mechanics of everything. Drew, jump on a call with Donnell because he shows everybody he's showing everybody his policy. Shows it to
and in
everybody.
addition, when we walk through examples, and because I've had this conversation with several people, when you see me walk through an example on this Vibe board, you best believe I've got the illustration to back it up. I'm not sharing with you number. Now, if I tell you I am making this number up just for round value purposes, then okay, I'm making this number up and there's not an illustration to support. But if I'm walking you through an example and I'm showing you what that graphical performance looks like, you better believe I've got an IUL illustration in my pocket to be able to back it up. I've done it several times on several lives. We've walked through several examples where I've used illustrations to also walk through those numbers. And if you're implying that maybe it's time for us to do that again, I will absolutely make a note of that so that we can bring that to the forefront. Because as I mentioned, what I've walked you through today, this is the same, I'll call it visual that I've used. Maybe I've changed the numbers, but it's the same visual because I've talked about this so much that I don't have to do new visuals. I just changed the numbers. So I can absolutely walk through a few more illustrations because I know this is something that has to be repeated. The same way we've been indoctrinated into thinking that our IRA and 401k is going to get us to a successful retirement is the same way I'm going to have to talk about this thing over and over and over again and use the same example. So I don't have a problem doing that.
All right. And Drew, welcome. We haven't seen you before, but welcome. We hope you come back. But Absolutely. Just because you commented, we're going to be spinning for a boat here in just a moment.
Let's get a boat.
Zaid popped in. What's up, Zaid? We're glad that you made it. He said, my employer won't release my 401k until I age out or have a hardship that clearly that qualifies. What are his options?
Yeah. Here's what we know. We know that your 401k with your current employer, your IRA with your SEP IRA with your current employer, your TSP with your current employer, your government 457 plan, your defined benefit plan with your current employer, you don't own them. They do. So unless they allow you to do what's called an in-service transfer, in-service transfer, which means you're going to your employer and you're saying, hey, I am interested in moving a portion, if not all of my retirement dollars to another qualified location. Another qualified location would be another IRA, 401k, 403b, TSP, or government 457 plan or annuity. So if they allow you to do what's called an in-service transfer, then you can move it. Otherwise, you don't have any control over it. Now, if we're talking about an IRA or some form of an IRA, a lot of times they will allow you to move or use or take your basis, meaning any match, any growth, any interest, they may not allow you to take, but your basis, what you've put in, they may allow you to move that as well. So it just kind of depends. Every employer is different, but the truth is you do not own the retirement account that you have with the employer that you work for. Your employer does, and they get to tell you what you can or cannot do with it. Just kind of is what it is.
Okay. Now is the important part, because we've talked a lot tonight about mindset. We've discussed at length about belief. What do you believe is possible for you in an outcome? What do you believe when we say, what is the goal? What do you believe that comes out of your mouth? And I think that's the most significant piece of all of this. It doesn't matter what stream you pop in or out of. This message is pretty consistent. It is, what is the goal? It's not our goal. Some people say, well, what would you do? Well, what we would do and what our goal is different from you. And that's why some people get frustrated. Somebody got frustrated with you the other day when they were saying, here's the money, what would you do with it?
Right.
And
Tell
you
me
said,
what I should do.
And you said, it depends. And they said, no, it shouldn't depend. No, it does depend, because the decisions that you'll make are tied to your belief about what's possible for you. The decisions that you'll make are tied to your belief of what your goal is and whether or not it's obtainable for you. Your decisions are tied to what you believe ultimately. And so if that belief is not tied to a strategy that will ensure that you will win, that the outcome of the point of using this strategy will produce the outcome that we are saying it will, then this strategy probably isn't for you. There are other ways to 10. And that is pretty much the answer to that question. But that's why we ask the question, what is the goal? Not what is the goal? Overall, everybody's goal. That's not because that doesn't matter. I can say financial freedom, and to me, that can mean something different than to you, right? No different than asking.
Having control over my time.
Yeah, right. It could mean a lot of different things to a lot of different people. However, how you get there looks very similar. How you achieve a goal looks very similar. And the first part is that commitment. The commitment to saying, this is truly what I want. I believe it. I can see it. I can imagine myself having this time. I can imagine myself having control. I can imagine myself walking in to fire my job because I have done something and that is producing income, whether or not I have time or the health to trade time for money anymore. And now we know that this is not just we're not out here being hope dealers, right? We know that this is possible. We know that it's possible because we had to get really serious and we had to build our own machine. Our machine looks different than other people's machines. That's okay. You can build a machine like our machine. Yes, you can, if that works for you. And so to Zaid, I would say sometimes this is where people have had to leave their jobs. They've stayed at their jobs because of their 401k. They've stayed at their jobs because of their benefits. But when they learn that those are not going to help them reach their goal, that's what actually gave them the freedom to leave, knowing that once they leave, even though that company owns the 401k, once you leave, it's now considered a previous employer's plan, and the rules are all changed at that point, sir. And now you do have full access to that, and you can roll it over into a self-directed account. They won't tell you that while you're there, of course, because it's a retention tool to keep you there, right?
You got it.
I got it. All right.
Brenda's question, she had a question that says, in-service transfers, are they allowed? They're allowed for annuities, correct? And the truth around that is a qualified account is a qualified account is a qualified account. So as long as you're able to do an in-service transfer, meaning if your company allows for an in-service transfer, that in-service transfer can be done to any qualified account. And yes, an annuity is a qualified account.
All right. We're spinning for a boat.
Let's go.
We're ready to do it. I'm ready to do it. Are you guys ready to do it?
Let's do it.
Let's get the...
I'm also ready to eat, just so we're clear.
All right, let's see. Oh, I was gonna play the boat. People are like, what the heck is the boat? Lolo. I'm excited about that.
Look at the size of Lolo's triangle, though. Doesn't it seem larger than everybody else?
I don't know. Maybe it's just because her name is taking up less space. That's got to be what it is. Some people are like, what is the boat? Should I play about the boat?
Let's get a couple winners and then we'll play it after the winners.
All right.
We can end on the.
All right, that sounds good. Hey, Carlos.
Nice job, Carlos. Hey, Carlos. I know we've been texting back and forth. So if you would, please text me. You don't have to. Well, your handle is your name, but text me your address. And actually, now that I think about it, I already have your address. But anyway, just text me, Carlos, your address so that we can make sure we throw it into the pool with the rest of those who have won a boat. So we make sure we keep track of it, and so we can get your boat headed your way.
Yeah, send us your address.
Yep.
That's the rules.
Name, address, and your handle.
Yeah, including you, Zaid, because you won a boat before you didn't collect the boat. Okay, let's go. Who else is gonna win? Come on, Bonita Ham.
So Bonita, yep. Text me your handle, your name, your address, and we'll get a boat over to you as well. And again, I think Bonita I already have as well. So
yeah, we didn't give a boat away last time. So,
Yeah, good.
all right. Are we done with the
I think
boats?
we're done.
Okay, I think that for those, I just want the reminder of why it matters so much, why what you believe matters greatly in this process. And so what I'm hoping is, and then now this will make the boats make sense. A lot of people who are new to tuning in, they go, "What the heck are these boats? Why are they giving these boats?" Well, show them what it is, Donnell.
Oh yeah, I forgot I had one right here.
Yeah, we need to put one. This is what it is. And in a second, right now, to anybody new, this just seems like this. What the heck are these boats they give away? Why is this a thing? You're going to find out why it's a thing and why there are other people who are going, "Psh, you know
Got
what?
my
I need a boat. Yeah, I got my
boat.
boat and I need another one. And you know what? If you spin the wheel and you get my name twice, send me another one because these are impactful. We should send them one to give to a friend, huh? Maybe that's a new thing. Vote for that, guys, if you want us to do that.
Lola,
Stop
like, how you
pointing
just
at
gonna skip
people,
over me?
Angelique.
Lola,
Gosh.
like, how you just gonna skip over me? I won. Like, give me my flowers.
What? Who?
Lolo.
Lolo. We did not skip over her.
Like, I won. Give me my
Yes.
flowers.
And she deserves to win. Who?
L. Fletcher.
He said
So it
spin the
sounds
wheel
like L.
again.
Fletcher. I don't know. It sounds like the wheel was not. His name was not showing on the wheel.
He's never in the wheel.
That's interesting. I vote that we get L. Fletcher a boat. L. Fletcher, text
Okay.
me. Put the number up for me, Frankie. L. Fletcher.
Yeah, that's not fair. And you've
text
been
me
in here tons of
your
times.
name and your address, and we will get that boat headed your way. Honorable
This
mention.
wheel. I feel like this wheel has done a couple people dirty. We need to find a new wheel.
L. Fletcher for the boat. Let's show them what the boat is about, sweetheart.
All right, we're going to show you what the boat is about, and then right after that, we're going to tell you how to gain access to this calculator that we've been using and a ton of free resources. Now, here's something that I saw in the chat, so we will part with this. They said, I went to the calculator did not work. Here's what you missed, and here's what I've been noticing about people. There is a video series that you get when you give us your email, all right? We send you access to a whole bunch of free tools. We don't spam you with a bunch of emails and texts and whatnot. We just send it all at one time. Why? Because we think that's annoying, and we think if you are going to take advantage of these tools, then you're going to value the fact that we're only sending them the one time, right? That way you can not have to wait until a week later or days later when we're going to send in do email marketing to you, right? Like that's not the point here. The point is that we're just being transparent. We're just going to send it all to you in the beginning. You can dive right in because that's what you said you wanted to do when you said, hey, I want to learn more. I need the information. So we're just like fire hose. Here's everything. You just come back to this email. It's all right here. Don't have to look for it. The problem is people aren't going into that information. They're looking for the calculator only. And the calculator is found inside the video series. And that's kind of the secret is that even though you can click on the calculator, it takes you to the video series. It is in there. That's the whole point. The exact calculator that he's using is in there. But when they type in the calculator, it brings them to a different version. Why? Because that's their situation. That's how they do it. We're trying to show you how to gain access to it. But if you went to a different thing and it looked different, then you're in the wrong place. And you need to go back to the email and read it so that you go to the right place. But here's the thing. If you watch the videos, it would all make sense. But people aren't watching the videos. They're not reading the book. They're not doing any of that. They're just looking for and kind of skipping around. And I get it. I do that too. I'm not on Netflix like reading all of the descriptions of things. I'm looking at the pictures, right? I make decisions. We do that. I get it. Totally get it. Feedback is important, so we want that. But we also want to make sure that you guys get access to the tools. So go back in your email. If you didn't get the email, let us know, and we will make sure it gets to you, including your boat. So on that note, we're gonna play the boat so you'll understand what it means and all there is to it and why these are so meaningful for us to be able to share with our community. Should we just play it? All right, hold on. We're gonna go.
In 1998, a British rowing team dreaming of the Olympic gold found themselves ranked 7th. Their focus had always been on the competition day, but they realized the keys to reaching their highest potential were hiding in the decisions that they'd make over those next 2 years.
Faced with two obvious choices, continue their current path and expect the same result, or give up, they discovered a third transformative option. They united under one guiding question: will it make the boat go faster? Every decision, every action was weighed against this mantra. If the answer was yes, they could or would have to do it.
If the answer was no, it was forbidden, non-negotiable. Prior to the competition, this team was doubted and ridiculed, but no one knew what they had been doing. And once they hit the water, they were nearly unrecognizable, achieved their pinnacle, and won the gold. So we ask you,
what is your goal? What are you willing to do to achieve it?
Will your story feel unrecognizable, even to you? Are you willing to light your beacon and stay focused, stay committed? Is your story non-negotiable, or are you waiting to find out how you ranked? Your financial future is not a game. You are only competing with yourself and those in the boat with you, your family and the many generations to come.
Will this make the boat go faster? A sounding alarm, a beacon of clarity amidst turbulent life decisions.
It's not just about speed, but direction, purpose, and an unwavering commitment. Every choice, every sacrifice aimed at the goal.
The first agreement this team made was to become fully self-directed, making their health their wealth, adopting a new perspective on their time and freedom, and the decisions they could fully control to reach their goal.
Will we make your boat go faster? That is our pledge to you. Our mission is to arm you with knowledge, strategies, and insights to ensure that not only you reach the goal, but you do so long before your race is over. All right. So on that note, we have a couple announcements to make. I hope that makes sense now why these boats are now so significant. They're no longer just a silly little toy. They have a strong meaning and as a visual representation of this concept to ask yourself every time you see this little totem, right? Will it make the boat go faster? It's a mantra in our home and in our family, and it's a concept that is powerful if used. So we hope that helps you. And Fletcher, send us your stuff so that stop pointing at people. Golly, send us your stuff. All the fingers.
Is that how the politicians do it?
That is the politician pointing. Okay, send us your stuff and we will get that to you. So a couple of announcements. One is we changed the time. So 4 p.m. Pacific Standard Time is now the new live stream, the new live time. It seems to be working out better for people, especially as we have more questions and we go longer and later. So I hope that this is working out. Your feedback is always important. We love that. But 4 p.m. Pacific Standard Time is now when we're starting for those who are confused. I am trying to schedule them in advance so that you can come back to the channel under the live tab and see where they are there. And here's a sneak peek for Wednesday. We're all getting ready for Thanksgiving. We're all going to see some people, whether we like them or not. No judgment here, do you? I'm just saying that when you get in front of these people, when you're around the table and everybody's talking what they're grateful for, and if you happen to say, I am grateful for access to information and new strategies to be able to secure my future. If you happen to say something like that and your Uncle Charlie is down at the end and he is just like, back in my day when we were getting ready for preparing for our retirement, this is what we did. And Uncle Charlie just wants to be a know-it-all. Uncle Charlie, matter of fact, he wants to tell you everything that you should do because this is what he did or this is the mistakes he saw others make. And you find yourself in the midst of battling conversations about personal finance, investment strategies at Thanksgiving. Better than politics probably, but I'm just going to say if that is probably going to be you, you're going to want to tune in on Wednesday because Wednesday we're going to talk about some hot takes on do's and don'ts of bringing up personal finance with your family members, whether you like them or not. So there's family members that you like, family members that you don't, and how to get out of conversations if you find yourself in the mix of a mess.
We had one lady, remember she was given play-by-play? She was texting you one year, play-by-play. She was like, okay, look, this is what my cousin just told me just now. What do I say? And it was play-by-play. She was like, I want to feel like I can represent my decisions in a confident manner. And eventually she could. But in the very beginning, she felt it was so frustrating to even talk about what it was she was doing. This is your permission to let it be your business. So that's that. But tune in Wednesday because we're going to talk more about that. Okay. And on that note, we like to always end with, if you didn't come from a wealthy family,
you can make sure a wealthy family comes from you.
So stay focused.
Stay protected.
Stay tuned.
Stay connected.
I'm Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
Here are those free resources, guys. Take advantage of them, and we'll see you on Wednesday. Stop pointing at people. 4 p.m. Pacific Standard Time. See you then, guys. Thanks for tuning in.
Have a good night.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get
self-directed.